range of outcomes as we move into next year is going to be wider. If the earning trends for the market are still moving higher, so I think that's positive.
The thing that you have to respect in the market right now is the momentum and just the optimism surrounding growth for 2025.
Before you jump immediately to what's going to happen next, understand that you got to wait because it's really complicated economics sorting all this out.
Trump doesn't take office until January. A lot of the initial policy moves may take 2 or 3 months to fully play out.
It's time to watch and let the policy take effect and see what happens.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, going into the weekend, heading towards a week of losses on the S&P 500. Equity futures right now look a little something like this. We're down another 0.6% on the S&P. On the Nasdaq 100, we're down by 0.9. Some fireworks in the bond market, the front end of the curve yesterday. This is what it looks like this morning. Yields just a touch lower, down 3 basis points, 431.81 on twos. But Chairman Powell shaking things up with this quote right here. The economy is not sending any signals that we need to be in a hurry to lower interest rates. The strength we are currently seeing in the economy gives us the ability to approach our decisions carefully.
He also goes on to talk about the path of the policy rate will depend on how the incoming data and the economic outlook evolve. So, of course, incoming data has been good, but that economic outlook potentially is policy uncertainty as you look on the horizon to 2025, what the political economy may look like with Trump 2.0. Is that giving Powell some leverage to maybe see through December and go have a pause?
To be fair, he said that the impact of that might not happen until 2026 or 2027. Either way, Anne-Marie, he's definitely giving himself some optionality here. He sounded a lot more like Kashkari and Logan over the past few days, where inflation has crept up in importance from the Fed. This is a very different Powell from August when he said the time has come to adjust policy.
Could not agree more. In the summer, we heard from two very different Chairman Powells. That one in Jackson Hole, Wyoming, and another one in Sintra, Portugal, when he talked about the strength of the economy being a reason to take our time to get this right. Just had echoes of that just yesterday, which is why we've got Evercore, the likes of Evercore and others this morning, saying the following: a December rate cut is not a lock.
And that's why you have the market responding to this. I think we got over our skis in putting the emphasis on the election and what that meant for the bond market. Yesterday was the perfect example of how that kind of trade can backfire on you. Basically, on the curve, you had the exact opposite that you had seen the day before. And so this reinvigorates the trade. The idea that inflation is a problem for the Fed and the labor market is looking healthy.
We are hyper data dependent. A little bit later this morning, we get US retail sales, payrolls December 6th, CPI December 11th, that Fed decision December 18th. And hopefully between now and then, we actually find out who's going to lead economic policy in the Trump administration, because we have had all of these picks and we can talk about them later in the program. We're still waiting for Treasury Secretary and the director of the NEC.
It's interesting because you think this would be one of the first names Trump actually comes out and goes on truth and says, this is the individual I'm going to have lead this economy. Because why? He ran an economic agenda. He ran a campaign where he was talking about the economy. He was talking about the fact that inflation was high under the Biden administration and those price levels have not come down. Yet, we are still waiting in the wings to decide who is going to lead the Treasury.
We know who it won't be. Jamie Dimon. Was it ever going to be Jamie Dimon?
I saw that shoot social and I was like, where is this coming from? Because we've seen this story before. He's already come out and said Jamie Dimon will not be my Treasury Secretary. Yesterday was Jamie Dimon will not be in the administration. Jamie Dimon quickly to Lisa saying, thank you for the note, but I don't have a boss for 25 years. I don't plan on having one. But I wonder what shareholders think of that, Jonathan. No boss?
More on that story a little bit later. I think they feel like they might be his boss. Equity futures on the S&P 500 right now, we're down by 0.6%. In the FX market, the euro's been weak. Just a little bit of strength this morning. We're up by 0.4%. Euro dollar 105.73. Coming up this hour, we'll catch up with Andrew Sheets of Morgan Stanley, looking for a rebound in M&A. We'll speak to Maya Macguineas of the Committee for a Responsible Federal Budget on Trump's to-do list, and Greg Melich of Evercore ISI, ahead of earnings from Walmart and from Target. We begin this hour with stocks falling after Fed Chair Jay Powell signaled the central bank is in no rush to cut interest rates, and investors continue to weigh potential Trump policies. The team over at Morgan Stanley looking for a Trump-driven M&A boom, writing the following: US election points to higher probability of a bull case outcome. Our base case is a 50% year-over-year increase in M&A announcements in 2025, with our bull case a larger 78% increase. Andrew Sheets of Morgan Stanley joins us now for more. Andrew, welcome back to the program, sir. Great to catch up with you following the election win for President Donald Trump, President-elect Donald Trump. I want your opinion now, Andrew, on what underpins that M&A boom. What are the policies that you're looking for that changes the story?
Yeah, thanks. Good morning. It's great to be here with you. So I think this is about some underlying positive trends for M&A now meeting some other more recent catalysts. I think if we take a step back, M&A is all about confidence. These are transactions that require a company to really believe in the outlook for several years in advance. And we've been through a period of a lot of economic volatility and uncertainty around how much would inflation rise? How much would interest rates rise? Would central banks ever start to cut? And if so, how much? Would the economy go into recession, which was a widespread fear last year and even for a lot of this year? And so I think in the background, you've had a lot of these macroeconomic uncertainties be resolved or look a lot better. And yet M&A has really lagged the strength you see in the economy, the strength you see in markets. And so one reason maybe why that gap still exists is there's still been lingering political uncertainty. Obviously, the U.S. election was a well-known event, an uncertain event, but with it passing, and I think with a lot of companies, we think we'll see the new administration as one that will be less regulatorily focused, more somewhat encouraging of animal spirits. We think that could be another further positive catalyst for more M&A.
Andrew, you cover credit. I think an important question in your world is how the M&A will be financed. How are you thinking about that?
Yeah, so another important element is you have willingness, we think, which will come from more confidence in the economic backdrop, maybe more confidence in regulatory policy, but also ability. Quite a bit of dry powder that's out there. So our colleagues estimate there's around $4 trillion of dry powder from private market investors. We think there's another $7.5 trillion US dollars equivalent sitting on non-financial balance sheets. And then you also have financing markets that are wide open. You've seen, $1.5 trillion of new issuance in the IG markets this year in the U.S. You've seen very low new issuance premiums, which suggests that investors are taking down that supply pretty happily. And I think you're at a level of yields which are still high enough to attract bond investors, but on the larger view are kind of roughly at the 100-year average, not scary for corporates, we think, in a material way. So kind of wide open financing markets, I think, are another important part of this story.
Does the mix stay the same, Andrew? Because if you have something like a junk bond, you can also go to the leveraged loan market. You can do high yield bonds and increasingly private credit. Does having the market open up in a more friendly M&A environment move us back towards what was the norm and going to the junk market?
Yeah, we do think we'll see more activity there, and also I do think that you have a backdrop where, as you mentioned, I think private credit will be an important part of this. Private credit has already been extremely closely linked and extremely important to leverage buyout activity over the last several years. If we think that leverage buyout activity resumes and increases, and we think it will, then that would also suggest an important role for private credit, and that's also a market with its own substantial amount of dry powder. And I think the strategic side is also important here. You also have, we think, kind of a significant amount of assets on private equity balance sheets or holdings that private equity will want to dispose of. These are quite mature assets that have been held for longer than normal. And I think the desire to look for a strategic buyer to those assets, especially when those strategic buyers have a very wide open corporate bond issuance market to finance through, is going to be a source of more activity.
Andrew, one of the other reasons, besides maybe stricter regulations, as to why we didn't see M&A was just higher rates. And yesterday we heard from a Jay Powell who seemingly gave himself the optionality to pause in one of the next upcoming meetings. How big of a risk of that is that if we see rates that stall out somewhere around current levels?
Yeah, so I think that issue of why rates are staying higher is incredibly important. I think as Chair Powell phrased it, he was very focused on the strength of the economy. And I think if rates are staying more elevated because the economy is strong, well, when did we see the highest M&A of prior cycles? 98, 99, 2000, or 2006, 2007, those were both periods with quite high interest rates. quite frankly, and quite high economic optimism. So I do think that there are plenty of historical examples where you can get more corporate activity at higher rates because there's confidence in the economy and because that confidence is starting to unlock more animal spirits. Now, if interest rates are staying higher because inflation resumes, or maybe because of tariff policy that drives higher prices, that might be different. And so I think we do have to stay focused on why rates are moving or staying elevated. But if they're staying elevated because the economy is strong, and I still think that's still the story through the first half of next year, I think that could certainly, correspond to still healthy M&A volumes.
You mentioned potential tariffs. Another political policy could be immigration policy. What kind of effect would that have on growth? And then is that a potential risk to this M&A boost you're expecting to see?
It would have a significant impact on growth. And again, I think one of the challenges of modeling major changes of immigration policy or even deportations is there's not much precedent for it in terms of thinking about the economic impact. And so the economic impact can be severe. And so I do think where markets are right now is maybe you could say in the easier phase of the optimism curve when no policy change has yet been implemented, and so kind of all options are still on the table. But I think as you move into 2025, whether or not many of these policies actually get implemented as stated is going to be incredibly important. And it's something that I think investors everywhere, ourselves included, are going to have to be reactive to. We're going to have to adjust our views as those policies change. I think this is also, though, important that, M&A is not just, in our view, a U.S. story. We're encouraged by the European Commission, which has taken, we think, or is going to be taking a more open view towards M&A in terms of encouraging more regional champions as you get maybe a little bit more of a multipolar world. There's still an important M&A story in Japan as it's embracing shareholder returns and corporate efficiency, and it does extend to other regions as well. So this is still a global story, even if I think the U.S. is leading and is likely to be the main focus of it.
Andrew, let's finish on that point. You're based in London. I'd love your view on what clients are saying about Europe right now. Credit spreads in America are super tight. Everyone wants a piece of the action at the moment. You talked about the animal spirits unlocking some real optimism about growth going forward in this country, at least for now. How easy or how difficult is it to sell the European story to clients at the moment?
Yeah, the European story has become more difficult, if I'm honest. I think Europe is facing increased uncertainty. It's been facing increased uncertainty on geopolitics with the new U.S. administration. It's facing more uncertainty on growth and tariffs. And, Europe went through this year with a weaker economic story, weaker growth, higher inflation than the U.S. did, a weaker macro backdrop to start with. So, I do think there is some valuation support. European equities, on a variety of ways you measure it, trade unusually cheap to the U.S., even adjusting for the usual discount. European credit trades at a discount to the U.S., but given those uncertainties, it's harder to close those gaps than I think it would have been before or under kind of different outcomes. And so I do think that's going to lead investors to be more focused and more favorable to the U.S., at least for the time being.
The election was a real game changer. Andrew, it's good to catch up, sir. Thank you. Andrew Sheets there of Morgan Stanley, looking for a boom in M&A. Equity futures right now on the S&P 500 attempted to bounce. We're still lower. We're down by 0.5%. With an update on stories elsewhere, here's your Bloomberg Brief with Yahira Hacker. Say, Yahira.
Hi, John. The Biden administration finalized a contract with TSMC to give the chipmaker over $6 billion in grants to bring production to the U.S. The chipmaker already reached some benchmarks and will earn at least $1 billion of the total amount this year. TSMC will also take up to $5 billion in loans. The award is part of the CHIPS Act aimed at boosting domestic semiconductor production. Meanwhile, Meta Platform saying it intends to appeal court rulings that allow states and school districts to sue the company over claims its apps are contributing to a mental health crisis among kids. The tech giant saying it will ask the Ninth Circuit Court of Appeals to review orders last month by a California federal judge who rejected the company's request to dismiss the complaints. The lawsuits brought by the school districts were also filed against TikTok, Snap, and Google. And it's official, New York is bringing its congestion pricing plan back. Governor Kathy Hochul is looking to push through a revised tolling plan, charging drivers $9 to drive into Manhattan's major business districts. Hochul plans to implement the new change on January 5th, before President-elect Trump takes office. Hochul introduced the congestion pricing plan with a $15 toll earlier this year, but with elections looming, she paused it, citing the financial pressures it would put on working families. That's your Bloomberg Brief. John?
And just like that, bang, the financial pressures disappeared because the election has passed.
Well, she's coming under fire from President-elect Trump. He says he has great respect for the governor, looks forward to working with her, but I strongly disagree with the decision on the congestion tax, so I don't think this is going away.
He's not the only one. Up next on the program, Jamie Dimon is out of the running.
I just want to tell the president also, I haven't had a boss for 25 years, and I'm not about ready to start.
Was he ever in the running? That conversation up next. Live from New York this morning. Good morning. The next up for this market, US retail sales, 8:30 Eastern Time. Going into that, equity futures lower. We're down by 0.6%. In the bond market, yields down just a basis point, 442.76. Under surveillance this morning, Jamie Dimon is out of the running.
I just want to tell the president also, I haven't had a boss for 25 years, and I'm not about ready to start. The most important thing is whoever had been elected, and this is my belief, they are entering and could be responsible for the most complicated geopolitical, military, and geoeconomic situation that the world has faced since World War II. And of course, I wish them all the best.
So here's the latest. President-elect Donald Trump rolling out Jamie Dimon for Treasury Secretary, writing, "I respect Jamie Dimon greatly, but he will not be invited to be part of the Trump administration. I thank Jamie for his outstanding service to our country." The two frontrunners remain investor Scott Besson and CEO Howard Lutnick. Mike Macguineas of the Committee for a Responsible Federal Budget warning the to-do list for them will be long. Given the enormous fiscal challenges in the near future, including critical deadlines, the role of the Treasury Secretary will be more important than ever. Maya joins us now for more. Maya, welcome to the programme. Always fantastic to catch up with you once again. Walk me through those critical deadlines. How big are they? How many are there?
Oh, there's so many things that whoever becomes the Secretary of Treasury will be inheriting. First off, they're inheriting a terrible fiscal situation, the worst we've ever had during peacetime, and it's about to be the worst we've ever had in the entire country. On top of that, we have these huge expiring tax cuts coming up next year. We have trillions of dollars of new promises that President-elect Trump has made in terms of things that he wants to implement. And we have things like the debt ceiling, which have been huge tussles in Congress before, leading us to some very scary deadlines when you're talking about the potential default. I think with a sweep of Republicans, that won't be as much of a problem. But there are a number of people who don't want to increase the debt ceiling and cast that vote no matter what. So the economic situation, which so far has been remarkably sort of safe as we've gotten out of the inflationary situation, is going to have many things that the new Treasury Secretary and President are going to have to navigate. And then when you look at the layers of promises, which would grow the debt, complicated policies like tariffs, this is not going to be an easy situation.
Promises don't always mean policy, though, as we know in U.S. politics. The top two contenders John talked about, Howard Lutnick, Scott Bessent. What do you make of these two picks? Or if you don't really know them that well, what kind of characteristics are you looking for in someone that can really guide through all these to-do list agenda items that you've just outlined?
Yeah, exactly. I don't know either of them well enough at all to make any specific comments on how they would be. I know they're both incredibly well-respected, well-regarded. I think an important thing is going to be the ability to push back in some of the president's desire to say yes to everything when it comes to fiscal policy. President Trump is a known entity. We've seen him before. And when he was in the White House last time, he really liked tax cuts, but he also really liked spending increases. And one of the things that we're going to need to have to grapple with is the trade-offs or the choices this time. I assume that they are going to extend the tax cuts. They need to figure out a way to offset those costs so they don't add $5 trillion to the debt, which is the projected cost. That could be from other revenue raisers or spending cuts, which would be something you would think a lot of Republicans would support. But I think the Treasury Secretary is going to have the role of really talking about why that's important. Second, I think the issues of tariffs are obviously an incredibly complicated policy, where if you think about how they affect the economy, how they affect fiscal policy, and/or how they affect national security, you come up with different takes on tariffs for each one of those. So explaining, or not explaining, I'm sure the president understands, but going through the trade-offs and the nuance of all of those in conjunction with the rest of the things that are going on in the economy, I think will be the role of the Treasury Secretary and the entire economic team. But it's President Trump has liked to have a diverse cabinet of diverse opinions. I really hope there is somebody in there who is pushing for fiscal responsibility, but also not just using the short-term metric of the market performance or short-term growth from borrowing, but looking at the long-term health of the economy. And as Jamie Dimon just said a minute ago, the geopolitical and the geoeconomic situations are really the most tenuous we've seen in decades. There wasn't sufficient discussion during the election, really, of the overall vision of how to contend with those. And that's going to have some real risks for the economy that you want somebody who's sophisticated and savvy.
Maya, when it comes to cutting spending, it brings me to DOGE, which your group put out a statement yesterday. And you said, we welcome the creation of this new entity to get under the hood of the federal government and look for ways to reduce inefficiencies. You say this effort is long overdue. Maya, can you name a single task force in the past that has actually been successful at cutting the budget?
Yeah, you know what we've seen? The answer is no at the time. And I am not optimistic about our political class doing anything hard right now. We need to raise revenues. We need to fix entitlements. We need to cut spending. We know all this. These things don't happen through regular order or through commissions. But what you do see is a lot of commissions, from Simpson-Bowles to the Grace Commission to Reinventing Government, that put out a lot of ideas that are on the shelf and sometimes get pulled off then about things that you can do later when you're looking for offsets. But quite frankly, when our Congress and the president look at how to cut spending, they always end up just relying on things like discretionary spending caps, which means they don't have to pick the actual choices, the actual spending cuts. The reason is there's a constituency for every program out there, and they're hard to push back on. But we desperately need to lift up the hood and look at a lot of places where we could certainly be both more efficient and cut outdated, inefficient, unnecessary spending, because our budget is absolutely bloated and we're not willing to pay for what we have, which means we continue to borrow more.
Maya, where would you do that? If you were to advise Ramaswamy and Musk, where would you tell them to look?
Well, I would tell them to look exactly where President Trump during the campaign said, don't look. But our biggest programs, our biggest problems, the industries are healthcare, national security, and tax expenditures, spending through the tax code. That's where you're going to find the biggest amount, trillions of dollars of waste over a decade, not in a single year, but over a decade. But I think you also have to look at our biggest programs for whether we really should be paying for those priorities. Social Security, we know, is headed towards insolvency in less than a decade. It will be great if somebody would be willing to talk honestly about the need to reform that program so it doesn't become insolvent and seniors have an across-the-board benefit cut. But within our actual budget, the healthcare industry is the place to start. There's so much waste and inefficiency, as we all know from the delivery of benefits, that anybody who's willing to tackle that and push back on some very powerful interest groups could find a lot of savings.
Well, maybe we'll get that in an RFK Jr. who has been very staunchly opposed to some of the big corporate spending. I mean, Maya, you seem a little skeptical of that. Let me just give you a chance to respond.
No, I mean, I think that you also have to make sure that your actual priorities are the right ones. And I don't know what his priorities will be, but I wouldn't say you just want to cut things without the sound policy base of what the overall government's objectives are. National security, keeping people safe, sound regulations, questioning which ones make sense and which ones don't. And so you start with the objectives, you figure out whether they're national objectives that should be done at the federal government level, you figure out the best ways to achieve them, you weigh the pros and cons, you don't pretend that everything is easy because it's not, and then you make some of the trade-offs. So I think that's what's going to be really important in this overall commission. Not simple answers, not it's easy, but like we have to start grappling with some of the more difficult things.
Maya, appreciate your time. As always, it's good to see you. Maya Macguineas there of the Committee for a Responsible Federal Budget. I hope Maya's not listening. Isaac Boltansky of BTIG putting a number on what he's expecting. Our initial read of the landscape is that there will be at least $7 trillion in new spending over a decade with no real clarity on the amount that will be offset.
And this was going to be the trajectory regardless of who won the election, because when you look at the promise on the campaign trail, of course, not all of them are policy, but you look at where the direction of travel was going for the Republican Party and the Democratic Party, there was going to, of course, be higher fiscal spending.
Isaac Boltansky joining us in about an hour from now. Look out for that conversation. Coming up on the program, President Biden preparing to meet with Chinese President Xi Jinping tomorrow. We'll discuss with Bloomberg's Enda Curran from New York City. You're watching Bloomberg TV. Heading towards a week of losses here on the S&P 500. We're down again this Friday morning, and good morning to you. We're down 0.5% on the S&P. On the Nasdaq 100, we're down by 0.75%. On the S&P, this, of course, follows the biggest weekly gain of the year so far, just last week when we had the US presidential election. This market's been quite difficult to sell for many of you. Michael Hartnett of Bank of America this morning: sell hubris and you buy humiliation. Let's see how this one works out. In the bond market, 2-year, 10-year, 30-year looks a little something like this. 2-year yields are down by 2 or 3 basis points to 4.3181. But on the week, still higher on the week, advancing for a 4th consecutive week, the longest such streak going back to April. We've just had this drip feed of data: CPI, PPI, jobless claims, retail sales later, eroding the perceived easing bias of the Federal Reserve.
It is yet again the pendulum has swung. One could argue that heading into the last meeting from the Fed, that we just got too over our skis with cuts. And then you get all this good data come in, and then the bond market needs to recalibrate, and then you get the U.S. election, and then we need to recalibrate again. And what you have in effect is a market that's running away from the Fed, that wants to cut, yet it is a bond market that keeps pushing yields higher.
That move in bond yields, of course, reviving that dollar story once again. 5 days of euro weakness into Friday. Just a little bit of euro strength this morning. Euro dollar at the moment shaping up as follows. We're trading at 105.77. We're up by 0.5%. The first day of euro strength going all the way back to last Thursday, a week ago. Under surveillance this morning, traders dialing back expectations for a December rate cut after Fed Chair Jay Powell signaled he's in no rush to lower rates further.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
And just like that, December now feels like a bit of a coin flip going into December.
Right. It feels like it's almost going to be potentially off the table, depending on what the next few data prints show us, which is why things like retail sales today is going to be important. Also, this idea of, and you both have been talking about this, optionality. They want to have options. And I just wonder, how much do they want to have options now because we have the outcome of the U.S. presidential election and the policies that might be on tap for 2025 could be inflationary.
I actually think this December meeting is going to be so interesting in regards to the politics, but maybe not the way most people are saying. If he pauses in December, how is that going to look to Donald Trump? That he cut right before the election by 75 basis points, and then right before Trump starts his term, he pauses. I mean, I don't know what that ire would do to Trump, whether he can do anything about it, but it could definitely stoke some tensions.
There will be truth socials by the storm if that happens. And actually, I was on the phone with someone when these headlines dropped yesterday during Powell's speech, and that was the conversation. You cut twice before the election, but now I'm about to come into power. I'm about to get inaugurated. You know I want lower interest rates, and you decide now is the time to hit pause. They're going to say it's political.
I agree with you both. December is going to be a fascinating Federal Reserve meeting. It's only about a month away. Let's talk about this story as well. It's been a busy 24 hours in markets. Reuters reporting President-elect Donald Trump plans to end the EV tax credit. Shares of Tesla and Rivian under pressure after the report, with sources telling Reuters Tesla representatives support the decision.
Yeah, Musk was posting on Twitter that the U.S. should, quote, end all subsidies, including those for TVs, oils, and gas. So he doesn't want subsidies in the market. And Danny, I know you're going to talk about the fact that actually this might help him. I looked at this report and I said, NSS, why are people at this moment deciding to sell these shares when Republicans have been talking about this literally for months? So you would have thought that the second that you saw that we were going to get this trifecta, that you would have saw this hit the stock market because this was already in the cards.
Right. And look, you saw in the reaction to the stocks, both Rivian and Tesla fell, but one of them fell a whole heck of a lot more than the other, and that's Rivian. I was just looking at these numbers. You have to figure only one of these companies can survive without subsidies. For every car that Rivian makes, they lose about $40,000. In the short term, sure, may be painful for both companies, but in the long term, Tesla is the clear winner from this, and maybe it clears out some of the competition.
Tesla turning positive in the pre-market. That stock is up now by about 0.25%. Let's talk about China. China's economy showing signs of balance in the fourth quarter. October data from the National Bureau of Statistics showing consumption growth nearly catching up to factory output. Retail sales expanding at the fastest pace in 8 months. And this is what many investors were positioning for, Danny. They want to see a whole lot more than just this.
I'm curious to know how much of this is temporary, because we have to remember late in September, China basically unleashed unleashed a lot of policy. And the net impact of that was a stock market that went through the roof, up some 20% in September alone. So how much of this is just a one-off? How much of this is just a one-off sentiment boost after that versus a China that not only needs to respond to keep that, but needs to give more stimulus, given what type of policies we might see from the Trump administration?
Could see some major tariffs in the next few months coming from the Trump administration. President Biden and Chinese President Xi Jinping is meeting in Peru on Saturday. Biden said to focus on maintaining stability as the relationship transitions into the Trump administration's hands. Bloomberg's Enda Curran joins us now for more. Enda, good morning to you, sir. Can you frame this meeting? What is this going to look like over the weekend?
It's really something of an exit interview for outgoing President Biden. You know, a taking stock exercise. If you think where we were a year ago, John, when APEC was over in San Francisco, that was a big meeting between both leaders. They set out new channels for military-to-military communications. They reopened cooperation, say, on AI and on narcotics control. And, of course, the Biden administration will say there's been progress on those fronts. But today's meeting will be nothing like that. President Biden, as we all know, is the lame duck. He's heading out the door. And not only that, President Xi will be sitting there looking right through this meeting, knowing that there's a very different administration coming in a couple of months now, not just on the trade front, but on the security front. We've seen some of the names being appointed to the cabinet, very hawkish when it comes to the China side of things. So, you know, it's a stock-taking exercise. It's a farewell between these two leaders who have met many times over the years, but hard to see anything major coming out of it, or hard to see anything in terms of a new direction coming out of this meeting.
Well, Enda, let's talk about the transition and the change, and let's talk about the difference in approach. Donald Trump is far more forceful, much more blunt. Joe Biden has claimed to be far more nuanced and much more targeted. Now, Enda, when I look at the Biden approach to China, I have to say we've got to highlight a failure to influence Chinese policy over the last 4 years. Is that going to change under Donald Trump?
Well, the Biden administration say they pursued, like you mentioned, John, this policy of intense diplomacy, and they say they eked out progress where they could in terms of cooperation, like we said, on AI, for example, or narcotics control. But there have been plenty of critics as well that the China-US story has stalled over the past few years, and that's given plenty of scope and ammunition for President Trump to come in and finish what he started in his first term. And he's highlighted in particular the trade side of things. Now, we don't yet know what President Trump is going to do there in terms of tariffs or other protectionist measures, but we do know two things. There's a lot of support among the business community for measures against cheap Chinese goods or cheap Chinese competition, accusing China of dumping in global markets. But equally, there's a significant business lobby that say tariffs will complicate their business, drive up their costs, and force them to make some fairly significant changes to how they operate. So on the headline basis, there's a case for rebalancing trade with China, but it's very complicated, and I think a lot of people are waiting to see just how this will be executed, because remember, the Biden administration was all about targeted tariffs, whereas it seems to be more broad brush in terms of what the incoming Trump administration is talking about.
And of course, we know the Secretary of State is a China hawk. He's actually been sanctioned by Beijing, but we're still waiting to see where a Ambassador Lighthizer would go in Trump 2.0. But we heard from Catherine Tai, who's right now the head of the USTR, and she says as an economic matter, as a political matter, a societal matter, no matter who is in charge in the United States, we cannot withstand a China shock 2.0. Is there a lot of distance, Enda, between a Catherine Tai and a Robert Lighthizer?
No, well, as you know well, there's been such a convergence on both sides of politics over the past decade when it comes to the China story. It's broadly speaking now the bipartisan hawkish view, whereas at the very least China is a strategic competitor. There needs to be measures taken to both boost and protect US industry. I mean, there's agreement on that. There's less agreement on how to do that. And let's not forget the global backdrop. The US officials down at APEC and at G20 next week, there's going to be plenty of pushback and plenty of messaging to Washington about the potential damaging effects from what's going to be happening over the coming years when it comes to tariffs. We've already had the Vietnam president making the point that tariffs and protectionism lead to recession, poverty and conflict. A very striking warning. You've had President Macron over the past few days warning about the prospects of a new trade war. So yes, the US can make its case that it needs to do more to protect its own industries, but it really has to sell that message in the global stage too.
When it comes to this exit interview, as you called it, not to be rude, but it almost feels like a waste of Xi Jinping's time, especially given the raw political power in the foreign policy space we've already seen the president-elect draw. But in these final months, is there something China and the United States could work on before Trump gets into the Oval Office?
I mean, as Jake Sullivan briefed reporters on, it's all about just maintaining that stability and consistency over the transition period and getting across the message that it's in both interests of both governments to keep that going into the next administration. But as we all know, this administration does not speak for the new one that will take over in January. They have a much more hawkish outlook on how to go about the China policy and what they're going to execute and which buttons they're going to push. And China knows that. They just don't know what exactly is coming down the pipe, and that's why they're waiting. They're waiting in terms of how much support they're going to put into their own economy, and they're waiting to see how they will respond until they get specifics. So, to your point, and there won't be much new coming out of the meeting between President Biden and Xi, because we all know in January, going forward, it will be a very different story.
On the point of China holding back, Enda, how much firepower are they holding back to support a domestic economy if it is more hit by policies coming out of a new White House?
I think it's fairly clear that they are holding back at the moment, Danny. They have significant room to spend more money at the central government level if they need to. They can even go and they don't have to borrow in global markets, but you saw the huge response to that Chinese US dollar bond this week, for example. I think they want to wait and see how the tariffs play out, which sectors will be impacted, and then they will respond by putting more money into the economy. They're keeping things ticking over at the moment. You saw the retail sales overnight. That's a little bit of a bump up there, heading in the right direction. If they can get growth to around that 5% target for this year, they'll probably take that. But there's no doubt that, if we're in a trade war, full-blown trade war 6 months from now, China will be forced to respond, and they'll have to respond forcefully on the ground in China too.
And how should we be thinking about some of China's international investments? After the first Trump administration, you saw China move out. They moved a lot into Mexico, something that Trump has specifically said that he will target. What could be the potential impact there of their investments in emerging markets, especially in LATAM?
There has been a big reshuffling of Chinese investment around the world and global investment. Remember, China used to be the go-to place to put your factory into, say, up to a decade ago. Now, companies have been shuffling production around the world to escape those US tariffs. But to your point, the US trade policy is wisening up to that, and they're starting to track where Chinese products, Chinese components might be coming out of China, going via third parties and into the US. So it might make that trade story more complicated. It might make the trade diversion out of China story more complicated if it's more of a universal tariff that the US is implementing, for example. And of course, we have to, again, wait for specifics to see what the Trump administration does, whether or not they, on paper, they're saying they will not welcome Chinese investment into the US. We'll have to see if that changes over time. But if we are in a trade war, a few months from now involving tariffs and export restrictions and other investment controls, there's no doubt that will make both investing in China more complicated and make doing business with Chinese companies in other countries more complicated too.
Enda, thank you, sir. Always fantastic to catch up with you as well. Enda Karen there of Bloomberg. Out of Washington, D.C. on the latest, who is at the top of the naughty list? Is it China? Is it Mexico? Or is it Europe? We caught up with Rob Casey in the last few days of Signum. And Signum are basically saying it's going to be Europe, Anne-Marie. That's top of the pile for them.
And they're preparing on what they could do when it comes to tariffs on Europe. But potentially this is going to be broad strokes. They're going to move quickly on Europe, on China, and looking at some of the factories that the Chinese are opening up in Mexico all at once.
Pricing in the good stuff, aren't we? Deregulation. We were talking about the M&A boom with Morgan Stanley earlier on this morning, the prospect of tax cuts. Then the sequencing shifts towards tariffs. That's going to be the focus into the new year.
It is, because the tariffs are the things that could come sooner. To Anne-Marie's point, it's the one that you can enact. And I wonder if this market can keep looking through it, because at the moment it is pricing it in that we're not going to have sweeping tariffs, that maybe it'll be one-offs. It will try to stoke more competition internally. How long can that last with a market, again, that might not get the tax cuts and deregulation that it wants until over a year from now?
Stocks right now negative by 0.5% with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Pool Corp and Domino's Pizza are moving higher in the pre-market after Berkshire Hathaway bought shares of both companies in the third quarter. That's according to a regulatory filing. The conglomerate also shedding most of its Ulta Beauty holdings, sending the retailer's stock down in the pre-market. Meanwhile, President-elect Donald Trump continues to fill out his cabinet, Trump saying he's tapping Robert F. Kennedy Jr. to run the Department of Health and Human Services. That puts the prominent vaccine skeptic atop a massive agency overseeing everything from food, vaccines, and medicine. Meanwhile, Trump has chosen Doug Burgum, the governor of North Dakota, to be the next Interior Secretary. The position will give Burgum a significant influence over plans to boost domestic energy production. Both picks will need to be confirmed by the Senate. And with Trump picking RFK Jr. to lead the Department of Health and Human Services, shares of vaccine makers, including Pfizer and Moderna, are falling in the pre-market. Trump saying that RFK Jr. will help take on the health crisis in the country and make America great and healthy again. That's your Bloomberg Brief. John?
Yahara, thank you. I think we've all seen exhaustive coverage of the vaccine story. Not enough on the food story. How will this individual work with the USDA? How will he really go to fight with the food lobby as well? It's the food companies, for me, that just take on a little bit more interest, given that everyone else is focused on the other stuff.
Well, when you hear what some senators have to say, it's the fact that he has been critical of the additives that are in American food, and that's what they like about him.
Yeah.
But then they say, not quite sure if we want him in charge of vaccine policy, though.
He's got some really valid points when it comes to nutrition, and I just wonder what that fight would look like if he can get confirmed. Up next on the program, looming Trump tariffs.
Any company that has not already started to move at least some of their production to other regions of the world is probably either in denial or they may not have a risk mitigation and security strategy that they probably should be having in place.
A conversation up next, live from New York. This is Bloomberg. As we work our way towards the weekend, here's a snapshot of the price action. Equity futures right now down by 0.5%. Bond yields just about unchanged. The 10-year 443.74. Under surveillance this morning, looming Trump tariffs.
Any company that has not already started to move at least some of their production to other regions of the world is probably either in denial or they may not have a risk mitigation and security strategy that they probably should be having in place. It's hard to know what exactly the impact is going to be, the timing of the impact, and even which products are going to be affected.
So here's the latest this morning. Retailers reporting over the next week facing down the prospect of higher tariffs and a shortened holiday shopping period. Greg Melich of Evercore ASI remaining optimistic. Election clarity is hopefully a cheap form of stimulus. Trump tariffs and tax cuts should prove neutral to positive. Greg joins us now for more. Greg, before we get into holiday shopping and the consumption boom we might see over the next few months, can we just talk about how these retailers might manage inventory between now and inauguration of President-elect Donald Trump, whether we're going to see these massive imports come from China, whether that's already started to get ahead of those tariffs?
Yeah, I don't think there's any surge ahead of tariffs. For a lot of large retailers and even smaller ones, we went through this a few years ago. So they have a playbook as to what they're going to need to do ahead of those sort of shifts. And I guess what I would say is right now they're still dealing with remembering very recently the problems we had with the ports on the West Coast a few years ago and getting that inventory in time. So I think they're being cautious in terms of how much inventory they bring in early or quick ahead of some theoretical tariff change, which will be very basically country and product specific probably at the end of the day.
Greg, how much more resilient are those supply chains now? Have they diverted traffic away from China? Is it going through somewhere else, away from Mexico? What are the big changes that you can identify?
It's a great question. I think from if we go back to the tariffs, so it's like back 2017, 2018, it looks like what retailers are bringing in from China is down probably 25 to 30%. A lot of that hasn't moved back to the U.S. It's moved to Mexico. It's moved to Vietnam. It's moved to India. So there's been a broadening out of the global supply chain. And this will probably further accelerate that trend to go to where products can come in with higher quality at a lower cost. And there might even be some reshoring as well, or nearshoring that has been part of the trend, but not the major movement.
Greg, the date I want to know about, not Trump's inauguration, but January 15th. That's when the deadline for the Longshoremen Association expires, and they need to come up with a new deal. What is the risk that we have a repeat or something worse than we did in months prior, especially with a new administration that's, for all accounts, less friendly to unions?
Look, that's a great question. And frankly, I'm glad you brought it up, because as we talk to retailers and vendors, we're finding that date, hopefully it'll get sorted, but that's still a very real and relevant date without any theoretical tariff changes in the future. So making sure that we have the products that we need if there is a disruption and if a final deal isn't signed by then is important. So look, there's a lot of moving pieces. And that's why I would say, even though we think the consumer's in a better spot and will be slightly better into next year, it's certainly not a V-shaped recovery by any stretch of the imagination.
Let's talk about that better spot for the short term. What do you anticipate the holiday season demand to look like?
We're looking for retail sales to settle out at this 3 to 3.5% nominal growth rate. We'll get October numbers later today, which we think will be in that range. And the things we're watching, it's really the categories that we think are starting to have rolling recoveries. We think home improvement is one that after 14 quarters of negative traffic at Home Depot and Lowe's, that's a category that will start to turn positive next year. Maybe not by first quarter, but certainly later in the year, because our home improvement lead indicator has had a pretty sharp acceleration the last 6 months.
Ahead of the holiday period, though, I'm looking at names like Target, Walmart, Amazon, when people are going to potentially go and buy some of these big ticket Christmas items. Who do you think is going to fare the best?
You know, I think it's the trend that we've seen all this year continues. The consumer is willing to spend, but they're very cautious and value focused, and they want to see newness. And what we've seen from that is Amazon, Walmart, and Costco so far have combined for 70% of retail dollar growth this year. So retail sales are up a little over 3%. If you X out those three retailers, retail sales are growing 1%. So I think for a lot of the other ones, it's really catching the right trend, having the right product, having the newness, making sure you lean into value. That's how some of those other retailers could hold through this. But I think those three, Amazon, Costco, and Walmart, are in a very good spot.
Apparently there's 5 fewer holiday shopping days when it comes to this season. Do you think that's going to affect the outlook?
Yes, I have the gray hair to remember when this had a bigger impact. I think that e-commerce growth to now 22-23% of U.S. retail sales has changed it, and maybe it's a little less of an impact because there's more flexibility in how people shop and acquire goods for holiday. But at the end of the day, I would say it might be 50 bips of pressure, all else equal, just because there's fewer days between Thanksgiving and Christmas to get stuff done.
They're trying to add days. Trust me, Greg. We went to Bloomingdale's day after Halloween. Straight away, Christmas music. Didn't stop, did they?
Jingle bells. It was ridiculous.
Greg, thank you, sir.
We had to get ready for it. Yeah.
Appreciate your time. Let's catch up again soon. Greg Melich there of Evercore. Just as we're talking about tariffs, new op-ed coming out from Scott Bessent. Scott Bessent, of course, a leading candidate to be the next Treasury Secretary under President-elect Donald Trump. This op-ed in Fox News this morning, and here's a key paragraph for you. The truth is that tariffs have a long and storied history as both a revenue-raising tool and a way of protecting strategically important industries in the United States. President-elect Donald Trump has added a third leg to the stool: tariffs as a negotiating tool with our trading partners.
This has been some of the criticism of whether or not Donald Trump was going to appoint him as Treasury Secretary. Was he not as forthright, and was he not as excited about using tariffs? I think putting this op-ed squarely in Fox News, he is making the case that I am on board with the tariff regime when you come into office.
It's in Fox News this morning on the website. Scott Bessent, let's talk about tariffs. It's time to revitalise Alexander Hamilton's favourite tool. Up next on the programme, in the second hour of Bloomberg Surveillance, we'll catch up with Phil Camporeale of JPMorgan Asset Management. We'll speak to Isaac Boltansky of BTIG, who puts a number on the Republican effort over the next 12 months. The tax cuts, all of that. He's talking $7 trillion. $7 trillion worth. We'll break down what's behind that $7 trillion a little bit later in the programme. We'll speak to Bloomberg's Ricchiuto on the future of automakers, and we'll catch up with Michael Kushma of Morgan Stanley following those comments from Chairman Powell just yesterday. Equity futures on the S&P 500 right now negative by 0.5%. In the bond market, 10-year yields are just about unchanged at 4.43. Your 2 years down 3 basis points to 4.32. From New York, this is Bloomberg.
The range of outcomes as we move into next year is going to be wider. If the earning trends for the market are still moving higher, so I think that's positive.
The thing that you have to respect in the market right now is the momentum and just the optimism surrounding growth for 2025.
Before you jump immediately to what's going to happen next, understand that you got to wait because it's really complicated economics sorting all this out.
Trump doesn't take office until January. A lot of the initial policy moves may take 2 or 3 months to fully play out.
It's time to watch and let the policy take effect and see what happens.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Retail sales in America are about 90 minutes away. Going into that, equity futures on the S&P 500 down across the board here on the S&P, on the Nasdaq too. On the S&P 500, we're down by 0.5%. On the Nasdaq 100, we're down by 0.8%. Chairman Powell in the last 24 hours really shaking up this market with this quote right here. The economy is not sending any signals that we need to be in a hurry to lower interest rates. The strength we are currently seeing in the economy gives us the ability to approach our decisions carefully.
And back in August, he said the time has come to adjust policy. This is a different sounding Powell. Not only is inflation stubbornly high, but it is a labor market, we saw with jobless claims yesterday, that continues to be strong. It's far from falling apart, and I think in retrospect, it's maybe a market that's asking, did we get over our skis in all of the cuts that we've been pricing?
He talked about the fact that this will also depend on incoming data. We already knew that, but then he said, and the economic outlook evolving. Well, it's going to evolve quite significantly in 2025 if some of those promises on the campaign trail from Donald Trump actually come to fruition with his trifecta in Washington, D.C.
We could see some major changes right now in the equity market. That rally does stall. Equities are down across the board. We're near session lows. We're down by 0.5%. In the bond market, we've had some big moves at the front end of the yield curve. We're heading towards a fourth weekly gain for a 2-year yield. The 2-year this morning, Danny, is down about 3 basis points at 431. But on the week, it's up again.
It is up again, and it's shaping up actually to be the front end of the curve that's more interesting. After the election, it had been the long end, it had been the fiscal concerns. That seems to be put to the side. Again, concerning ourselves with what's happening with these rate decisions. I do think in the long term, though, it was really interesting to hear Powell talk about tariffs and said his concern is growth. It's not inflation. He's concerned that it's going to hamper growth at a time when they're trying to reinvigorate it. So he actually might be fighting a different battle than we've been talking about.
Which is why retail sales is so much more important at 8:30 Eastern Time to get a read on the US consumer. Coming up this hour, we'll catch up with Phil Camporeale of JPMorgan as the post-election rally runs out of steam, Isaac Boltansky of BTIG as President-elect Donald Trump unveils more cabinet picks, and Bloomberg's Craig Trudell on the future of EV tax credits. We begin this hour with stocks lower and heading towards a week of losses following Fed Chair Jay Powell's hawkish comments, saying the FOMC is in no rush to cut rates again. Phil Camporeale of JPMorgan saying the pace of easing will be much slower going forward. The labour market weakness from the summer was misread. As long as the Fed can continue to carefully bring rates down over the next year, our thesis of a soft landing and a broadening out of equity returns will be supported. Phil joins us now for more. Phil, good morning to you. It's good to see you.
Good morning. Good to see you.
Haven't seen you since the election, and last time we spoke, you were super bullish. Are you even more bullish now?
Yeah, so before the election, we were saying it's going to be really hard to fade U.S. exceptionalism. We just didn't know if it was going to be U.S. exceptionalism in lowercase with a period, or U.S. exceptionalism in like big, bold letters with an exclamation point. And I think we got the exclamation point. Okay, so we're still bullish. We're still overweight by 10%. We were 10% overweight equity the day before the election. We're 10% overweight today. And the two words that I took from Chairman Powell's quote yesterday, you know, the whole world focused on hurry to cut rates. Mine was strength and economy, right? And that's the fundamental story, particularly with the U.S. consumer, John. I've been on this program talking about the U.S. consumer a lot. They're the most important consumer to get right. And October gave us such a big signal. It was the largest 1-month gain in consumer confidence since the reopening of 21, the biggest contribution to consumption in the third quarter since the beginning of 2023, and the BEA found about $1 trillion when they revised the savings rate higher. So the U.S. consumer to us looks strong. The bottom line for us, 15% probability of recession over the next 12 months. 15
Sure.
is as low as you could possibly get. And, you know, for us, because it's no such thing as zero probability. And at the end of the day, you want to make a big deal about rates. The average 10-year rate this year has been 4.2. We're at 4.4, and the S&P has squeaked out 25% gain. Okay, so it's a pretty supportive environment for us still because of the fundamental signal.
That's the story. It's a beautiful story.
Thank you.
Got to talk about the price of the story. Let's talk about the price of the story.
Yeah.
Credit spreads are really tight. Forward multiples are pretty elevated. We are seeing the data come in pretty strong, but that's well priced. We've taken out a lot of rate cuts already for the Federal Reserve. Just how well priced is this story?
Yeah, good question. So when when we were here pretty much up through the summer, we were talking about the cap-weighted S&P. We were talking about mega cap tech. That's still part of the story, John. But our two latest trades have not been that. One has been equal weight. Okay, so arbitrarily just get a little bit of every stock. But I think one of the ones that's really coming up is mid-cap now. So mid-cap for us makes sense for three reasons. One, valuation, 17 times versus the 22 times that you're quoting on the S&P. We have about a 13% earnings growth for next year, which looks pretty good. And you just don't need as many rate cuts. Like, it's got a little bit less sensitivity than small cap. I mean, yes, we could have jumped into the deep end of the pool and bought small cap, but we're getting there through mid cap. So it's a broadening out of U.S. exceptionalism. Don't bail on the mega cap, but we're diversifying that with some other things. And then high yield at the end of the day, yeah. I mean, how tight could it go? It's like the two-faced high yield market. You have this like 5th percentile spread. Right? And then you look at it again and you're like, oh my goodness, it's 50th percentile all in yield. And a lot of our clients just want the yield, including us. We want this boring, less glamorous alpha trade of out-yielding our index in a world where the fundamental story continues to support high yield.
Well, usually one trade that works pretty well is the more credit spreads tighten, the better risk assets as a whole do. If there's just less room now for credit spreads to tighten, does that put any ceiling on risk overall, or just the correlation's all out of whack considering how tight things have gotten?
Yeah, so that's a good point. I think it's a whole story, Danny, of like macro volatility coming down. I could make... this might not get the best ratings, but I can make the case that uncertainty is actually less now, not more. Post-election, we know who's there. We know also that if history is a guide, a lot of companies tend to put money to work no matter who they voted for after an election, which I think can support the broadening out rally that I'm talking about. We're not expecting high yield to tighten. Maybe it should trade through treasuries because one of those has 100% debt to GDP and one of them doesn't. But that's not going to happen. I think at the end of the day, the high yield story is in the background. Janet Yellen said it's like watching paint dry. That's what she wanted monetary policy to be. That's what we want the high yield carry to be in our portfolio.
Okay, so the rally broadens out, but does leadership change?
Yeah, I think that's the key. I think leadership does change. I think it changes to things that are more pro-cyclical. So remember what I said, U.S. exceptionalism, bold letters, exclamation point, that just doesn't mean mega cap. I think it means that you have the financials and industrials taking part, and that's how we're positioned for next year. I mean, we have our soft landing definition is about 2 to 2.5% growth, 2 to 2.5% inflation. If you just Google nominal growth of 5 with earnings, you get a lot of leadership in that environment. And I think that's pretty supportive. And one of the things I really don't want to see is a 50 basis point rate cut. I don't want to see that, and I don't want to see a 2% CPI rate, because I think if that's happening, we're wrong on the fundamental story and the growth story.
Last week, immediately after that election, we began to price what looked like a really positive growth shock.
Yeah.
Really loud. And Mohamed El-Erian came on the program and he said that sound is the sucking sound of capital being taken away from the rest of the world into the United States. You keep saying U.S. exceptionalism. Where does it leave Europe? Where does it leave China? Where does it leave Japan? Where does it leave EM?
Okay. You want me to answer all those?
Please.
So I think if I were going pecking order here, I think it would go to the U.S. So out of our 10% overweight, 80% of that is in the U.S. And then the other piece, John, we have a small piece in emerging markets. So, in 2016, if you listen to anything President Trump said on the campaign trail, you wouldn't have touched EM with a 10-foot pole. In 2017, EM was up 38% because of the coordinated global growth theme. So the fundamentals kind of went out there. I'm not saying that's going to happen this time, but, we do have an environment where at least China is acknowledging their property market. It's fallen flat again, but it is somewhere where we just want to be careful of being too underweight. And then the Japan story, it just gets a little complicated with the Bank of Japan normalizing rates and what that does to dollar yen. I think it makes it a little bit easier if the Fed's not going as much, that the Bank of Japan can start to normalize, and it won't be like that early August trade. So in terms of pecking order, I think it would go U.S., EM, Japan, and then Europe would be a funding source at this point. They're growing at 1, we're growing at 3. European Central Bank is cutting, and we only have 75 basis points of easing priced out to the end of next year. Okay, and that's kind of a weaker euro story, which isn't great for investors here in the U.S.
Phil, you sound so bullish. What's the risk of Donald Trump putting on tariffs that are blanket, 60% on Chinese imports and 10% from everywhere else?
Yeah, so Emery, I go back to 2019. President Trump lost the majority in the midterm elections of 2018, and growth that year was 3, and inflation was 2, and the Fed was cutting. And I just don't know if these tariffs are going to lead to the inflation. I think it could be more of a growth side. But policy error, Anne-Marie, probably is our biggest risk, whether it be from the administration or whether it be from the Federal Reserve. And I think the Federal Reserve kind of got the message. They thought the unemployment rate was going to be 4.4 at the end of this year. It's 4.1. But to your point, policy error is probably the biggest risk. It's not the left tail. It's not recession. It's policy error from either the administration or the Fed.
Then what would be the catalyst for that 15% recession call possibility you have, which I know is low, but what would be the catalyst?
It would be business caution and then kind of layoff. So we're watching initial jobless claims really closely. So do claims or the labor market show signs of cracking? There was like this hoodwink earlier this year that the Fed fell for, and Claudia Sahm was like, no, it's not happening. So I think at the end of the day, it would have to come from the labor market, Anne-Marie, and then the uncertainty, as you said, on tariffs, on growth. And then that's the business caution, and it kind of goes the other way. Not priced in right now.
Claudia turned out to be right, at least so far. Jobless claims yesterday, 217. Phil, it's wonderful to catch up with you.
Thank you.
To get an update on your thoughts. Thank you, sir. Phil Camporeale there of JPMorgan. Equities are a little bit softer on the morning so far, with an update on stories elsewhere. Let's catch up with Yahara Hakez for your Bloomberg Brief.
Hi, John. Shares of Rivian and General Motors are falling while Tesla is recovering in the pre-market. This after Reuters reported President-elect Donald Trump plans to kill the $7,500 EV tax credit. The move would deal a major blow to EV adoption in the U.S., which has already weakened due to still high prices and the lack of charging infrastructure. Trump has previously said he would reverse President Joe Biden's EV policies on day one of his presidency. Meanwhile, Disney predicting $1 billion in operating earnings from streaming for the fiscal year, and it has plans to increase profit margins through price increases, higher ad sales, and a password sharing crackdown. Profit from Disney's direct-to-consumer division surpassed earnings compared to its film division in the last quarter. And get ready to rumble. 58-year-old Mike Tyson will face 27-year-old Jake Paul in the ring at AT&T Stadium in Arlington, Texas tonight. The two completed a weigh-in yesterday with Tyson slapping Paul in the face. Tyson is considered to be one of the greatest heavyweight boxers of all time, of course, while Paul has successfully faced off against different opponents, with his only loss coming from boxer Tommy Fury last year. The event will be streamed live on Netflix. That's your Bloomberg Brief. John?
Yahara, thank you. Boxing is just dead to me. It's like merging with WWE over the last few years. It's so sad.
Isn't it always been like entertainment and flash and, has it ever been a real sport?
There used to be a raw realness to it about where these people had come from and their hard lives and the effort and the discipline they generated over time to ultimately go onto the world's biggest stage. But what it is now is just pure, raw entertainment. I don't even know what it is. How many rounds are they fighting? I don't even know.
I refuse to know. I refuse to know anything about this, John. I'm just going to tune out.
We'll leave that there. I don't think anyone around this table will be watching. Up next on the program, installing the Trump team.
All options are on the table, including recess appointments. Hopefully it doesn't get to that, but we'll find out fairly quickly whether the Democrats want to play ball or not.
That conversation up next, live from New York City. Good morning. Equity futures on the S&P positive here by 0.5%. Just a little bit of stability in the bond market. The 10-year, 443.74. Under surveillance this morning, installing the Trump team.
The president got a big mandate. The American people want change in this country. He wants to get a team in place that can do that, and we're going to work with him to see that he gets his team installed as quickly as possible so he can implement his agenda. All options are on the table, including recess appointments. Hopefully it doesn't get to that, but we'll find out fairly quickly whether the Democrats want to play ball or not.
So here's the latest. President-elect Donald Trump moving quickly to assemble his cabinet as many expect Republicans to hit the ground running next year. Isaac Boltansky of BTIG writing, our view is that lawmakers will move quickly to shape a tax spending package, and our channel checks suggest that they are targeting March, April for votes. Isaac joins us now for more. Isaac, that's a really aggressive timetable, and you put a number on things as well in your latest note. Our initial read of the landscape is that there will be at least $7 trillion in new spending over a decade, with no real clarity on the amount that will be offset. Isaac, what goes into that 7 number? What's behind $7 trillion?
Well, look, we're starting, John, with $5 trillion just to extend the Tax Cut and Jobs Act that portions that are expiring at the end of next year, as well as some that have expired over the past few years. So we're starting at just about $5 trillion. Then you have to layer on some of the items that the president promised from the campaign trail or other issues or priorities for members of the Hill. And so I think 7.5 is a fair framing device. The unknown for all of us, and I can tell you what a lot of folks in DC right now are doing, is building out their pay for list. And I think that's something that you're going to hear a lot of over the next few weeks in terms of, hey, can they use tariff revenue as a means of offsetting some of these costs? Where are they going to find other pay fors? Is it the Department of Government Efficiency? Is it other areas of the government? We don't know. That's going to take some time. And ultimately, it's going to take some process and some iterative back and forth with the CBO to figure out how much all of these things cost. But I'll tell you, the first shot across the bow was the comments from the president yesterday regarding electric vehicles. And that's a big pay for right there. That's a couple $100 billion right off the bat.
What else could we see? I mean, the fact that we are going to see this trifecta in Congress and the executive branch dial back something like the Inflation Reduction Act wasn't exactly shocking to me. They've been talking about it for months. What else could we see potentially get rid of that the Biden administration had put forward?
Sure. Look, and I think that's a fair framing. We all knew that the Trump administration was going to go after the IRA. What we've tried to do, though, is try to look at cost of these provisions and then their political risk. And so, for example, within the Inflation Reduction Act, of course, electric vehicles were going to get scrutinized and lightly cut back. But other portions of that bill have broad bipartisan support. You know, things like hydrogen, the production tax credits, the ITC, those things have broad support and should see continued support and should survive this process. I'm looking at other areas, things that maybe haven't gotten as much focus. For example, graduate student lending. That's one area where you could see the government pull back. I also think that they're going to focus a fair amount on turning some of these dials. So we're not going to see a lot of these provisions extended for the full 10 years. Instead, what you're going to see is we'll have 2 or 3 years of clarity, and they'll push it out as far as they can in order to goal seek for that deficit reduction number that they're looking for.
Isaac, you have one of the most aggressive timelines I've heard anyone talk about when it comes to this package. March and April for votes. Are you assuming that we're going to sail through these cabinet appointments in the Senate so that they can move on to agenda items like this?
Well, look, my viewpoint on this is I think that they're going to start fast. And that's what I'm trying to get clients ready for. I think that you're going to have the initial movement in the House that early because they have a wafer-thin majority. And we've got to keep in mind with these House members, there's normal attrition, right? You see resignations, you see death, you see folks going to jail, right? These are normal happenings for the House of Representatives. And so I think that they're going to move quickly to try to capture some of the mandate that they clearly have received from the electorate, as well as to ensure that they have some movement while they have the majority and while they have cohesion around their goal. I think that it will still take time to get this through the Senate. I think there'll be back and forth. I think that this thing will die a dozen times before it's done. My point is, I just think they're going to start faster than they did previously. And we've got to get ready for those headlines to start flowing accordingly.
Well, we're still waiting for the headline and who he's going to pick to shepherd some of this through when it comes to things like spending, like the Treasury Secretary. Yesterday, we heard from Senator John Thune on Fox talking about the advice and consent role that Congress plays when it comes to these confirmation process of the president-elect's picks. Do you think that's how it will be? Will this be a process-driven approach, or do you think the Senate will bow down to GJT and basically say, we'll give you the recess?
I mean, look, I think that ultimately what we're seeing right now is a bit of the flooding of the zone with nominees. And from my seat, I find it incredibly difficult to believe that Senate Republicans are going to reject multiple controversial nominees from the president. I mean, it was wild to me, Anne-Marie, to speak to Democratic contacts last night who were saying maybe Mitch McConnell will come and save us. Maybe he will be the knight in shining armor. You know, if Democrats are waiting for Mitch McConnell to save them, I hope they brought a book because it's unclear to me that he's going to show up anytime soon. And so ultimately, the way I frame this with clients is I think that we'll have some failures on the nomination front. And Gates is a good example for Attorney General. That one is already troubled, and I would bet on that one to probably go down. But the rest of them, I think, are going to go forward. And this is something just yesterday we saw with RFK Jr., where I think that because of the focus and the ire being on so many of the other nominations, and because of the fact that there's going to be a bit of attrition here where they simply just don't want to reject every single nomination, plus you add in the risk of a recess appointment, and our base case is the vast majority of these nominees are going to get confirmed. And I think that's both arithmetic and politics.
So in your assumption, RFK Jr. is someone who is able to get confirmed. If we do see that, Isaac, you saw already pharma stocks reacting yesterday, specifically vaccine stocks. What sort of impact could an RFK Jr. at HHS actually have on the system?
You know, the one I'm watching right now is what does he do in terms of the staffing and the workforce there? I mean, what you've seen in DC circles is a lot of commentary about folks at, for example, the FDA and other agencies under the purview of the HHS possibly leaving. And I think that's meaningful from a timeline perspective for approvals. That's one thing that I know clients already care about. I think there's some questions about his capacity to run a sprawling agency with $2 trillion in spending. I think that's a real concern for the market. Other items I think that we're going to have to digest and probably dismiss. You know, I don't think that he's going to ban direct-to-consumer pharma advertising, right? I think that's something he's talked about, but he's probably not going to do. There are a number of those items on his list that I don't think he will do. There are broader questions, of course, about his impact on public health. That's a bit outside of my purview. My focus is just on what the market impact is going to be. And I think that, once again, with him and with all of these nominees, we've got to remember that there is a divide between the rhetoric that we've heard and the reality once they actually get into the seats.
Right, and to your point, they're going to be facing huge bureaucratic institutions. If a lot of these picks, the aim is for them to come in, make cuts, make things more efficient, Isaac, how much of that will they actually be able to do, or will they be facing a different reality once they're appointed?
Look, we've got to keep in mind that the Trump administration is moving quickly, right? And I think that folks have been surprised that this is year 5 of Trump and not year 1. I mean, he's moving quickly on a number of fronts and showing some experience that we didn't see the first round. But even when you talk to Team Trump folks, they say they've got a good 18 months, right? They've got 18 months of runway to move quickly. So there's a prioritization hierarchy that's already happening in terms of what can get done before we all turn our focus to the midterms and we start looking at Trump is a lame duck. And so, look, there are going to be 1 or 2 items for each of these secretaries that they're going to be able to focus on from an administrative perspective, because in addition to that, they're also going to have to be out there selling the tax cuts and probably the tariffs. And so that's going to be a big part of their day job as well.
Isaac, 10 seconds. Give us a name. Who gets the Treasury seat?
I'm still in the Bessent camp. I think that ultimately he has the background from a geopolitical perspective. And of course, we know that he has what is most important to the president, which is he looks the part.
And he is the market favourite right now. Isaac, appreciate it, sir. Isaac Boltansky of BTIG. Isaac with a compliment at the end. I'm sure Scott would like that.
Well, I think the president-elect has called him, quote, central casting when it comes to Scott Bessent.
New op-ed out on Fox News from Scott Bessent this morning saying this about tariffs, that President-elect Donald Trump has added a third leg to the stool. Tariffs are a negotiating tool with our trading partners. There's a reason why I think Scott has become a market favourite over the last few weeks.
Well, yes, because he could be someone who maybe he's going to embrace tariffs, but he's not going to be maybe as enthusiastic as, say, a Robert Lighthizer. Remember what I said the other day? It's the angel and the devil on your shoulder.
Yeah, Lighthizer would be market negative. Let's put it that way.
And that's not what Donald Trump would like.
Equity futures on the S&P 500 right now, negative by 0.5%. From New York City, you're watching Bloomberg TV. Just off session lows in the equity market. On the S&P 500, we're negative by 0.5. The weight of the losses on the Nasdaq 100, we're down by 0.8. With 2 hours until the opening bell, here's your morning movers with Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. Let's kick it off with Applied Materials. Your biggest customers are Intel, TSMC, and over 30% of your business is in China. You've got double walls of fear coming towards you here. The guidance, modest guidance. That's what's really irked the market. They're going to make $7 and $8 billion, plus or minus 400,000. Now, that really is what has taken this market lower this morning, this stock lower this morning. We think that the China business is normalizing. That's what they've said to us. But this is a slippage relative to the recent quarters. So just keep an eye on that. The headwinds are there. And then, of course, if you get more export controls, it's like doubling down on the negative. Roll it over and have a look at ground zero in China. Yes, you've got retail sales up the most in 8 months in China. That is the big backdrop. When it comes to Alibaba, it is just the sheer size of this company. It's gone through a massive, massive change about their dominant position. The sales were lighter than estimated, but Eddie Wu says we are in the most confident in our core business than we have ever been. And the core business is e-commerce and the cloud. And the cloud was up 7%, the strongest in 6 quarters. This is a recast Alibaba, fit for purpose, China in the late 2020s. I'll leave you with a slice of pizza for the weekend. This stock is up, Domino's. We understand that, and there's an important distinction here. Berkshire Hathaway has taken a slice, not necessarily Warren Buffett. This portion that they've taken is under $1 billion. Warren Buffett typically doesn't really get involved or play in anything less than $1 billion. So we think it is Ted Weschler and Todd Coombs who've taken a slice out of Domino's. There you go for a Friday.
You don't strike me as a Domino's kind of guy, Manus.
Yeah, I'm a Broadchurch.
Just saying. Manus used to say to us in London, no carbs before Marps, right?
Yeah.
Remember that?
He's a no-carb guy.
Marbella, if anyone's following at home. Under surveillance this morning, shares of vaccine makers falling after Donald Trump taps Robert F. Kennedy Jr. to lead the Department of Health and Human Services. Trump saying the Kennedy, known as a vaccine skeptic, will help take on the health crisis in the country and make America great and healthy again.
So there's two visions when it comes to RFK. There's individuals who like what he has said about health, about the additives that we have in U.S. processed food. He's talked a lot about on the campaign trail things like Fruit Loops. A lot of moms really loved this. But then it comes to the vaccine skeptic issue that a lot of senators may have a problem with. Interesting, though, Isaac Boltansky just said there he thinks he gets through. It's going to be contentious, but he thinks he gets through. Because why? The Senate can't say no to everyone Donald Trump puts in front of them. And the one that's most likely not going to get through is going to be AG Matt Gaetz.
But if he's likely to get through, this is why I find the market reaction kind of confusing. OK, I understand the gut punch vaccine makers fall. But why not processed food? I basically tried to look up every single processed food maker. Mondelez, General Mills, PepsiCo, Bayer makes chemicals. All of them gained yesterday. There seems to be a bit of an inconsistency to this market and how it's really reacting to him.
Well, maybe it could be because some of these companies like Kellogg's, and I looked up, they put things like BHT in American Fruit Loops, but they actually use, say, a beetroot extract to make Fruit Loops in Canada. Maybe they'll just start doing things like that in the United States.
Which ultimately is what he'd like to see.
But that would make it more expensive for these companies. Their margins get worse, and therefore, maybe, I don't know, they should be falling too.
The fight that he's going to have, can you imagine the pharma lobby and the food lobby simultaneously in Washington, D.C.? Be interested to see who gets USDA, because there's going to have to be a close partnership with those two if he wants to do the kind of things that he's talking about.
And we are talking about a massive institution, even bigger than the defense budget. $1.7 trillion, 80,000 employees. And it goes from things like Medicare to vaccines. I mean, he has a purview under him will be massive, which is why this is going to be very contentious. And remember, they can only lose 3 votes on the Republican side. So 50 senators have to say yay to this one.
Isaac Boltansky of BTIG said the president-elect was flooding the zone with nominations over the past few days. But there is this just like empty seat that we're all waiting to be filled. Economics was at the epicenter of the campaign. It was at the epicenter of the election. We need to see who's going to run NEC, National Economic Council, who will be the director. We need to work out who's going to be the Treasury Secretary. Have we had commerce yet? Either we need to work out all these things.
No, we haven't had the crux of what's going to be the economic team, which usually is what is so important to the former real estate developer turned president, Donald Trump. He cares about the economy. He campaigned about the economy. Well, where's your economic team? We should know Treasury soon. Today, we have Senator Lindsey Graham apparently pushing for fellow South Carolina Scott Bessent to be Donald Trump's next Treasury Secretary, according to the Wall Street Journal. This after there seemed to be some kerfuffle with Wall Street Journal also reporting that Howard Lutnick threw his name into the ring at the last moment. Remember, this is the person running the transition and then decided he wanted to step in and take one of the roles.
Yeah, that's a wrinkle in the transition that maybe the president-elect did not want to see. Watch this space over the weekend. Maybe we get some news. Elsewhere, the FTC preparing to launch an investigation into anti-competitive practices at Microsoft's cloud computing business. business. This, according to the Financial Times, the FTC examining allegations that Microsoft is abusing its market power by preventing customers from moving their data from its Azure cloud service to competing platforms. Danny, that stock is down about 0.5%.
And maybe the reason it's not down more is because, by all accounts, Lina Khan is not going to be staying on in a new Trump administration. It's this feeling of like maybe she's working on her legacy until the last day. It's a weird one because it's Microsoft in the cloud, which, by the way, they're not the leader in. And she's done this frequently. I just wonder, in a new Trump administration, will any of the, conservatives try to carry this through into a Trump administration?
Well, here's the question. Once we get Treasury Secretary, then who becomes FTC? Who gets the helm of SEC? These are a lot of questions that the market is waiting for, but you nailed it. This doesn't feel like actually it has a lot of legs to it. It feels like Lina Khan's trying to take one last bite out of the apple before she gets replaced.
Speaking of that, here's another bite out of the apple before this one gets replaced. US Trade Representative Katherine Tai saying targeted tariffs are needed to guard against imports of goods from China, but cautioning against the use of blanket tariffs like those described by Donald Trump.
And she also talked about this idea of a China shock. She says we do not want to see a China shock. Basically, when China joined the WTO in 2011, it was basically all this devastation for a number of industries. So when she says things like that, though, what is the distance between Katherine Tai and Robert Lighthizer? They both seem like China hawks, but maybe in a Biden administration, a Katherine Tai was regulated by, say, a Janet Yellen and other individuals like Lael Brainerd.
I just wonder if Trump's approach to this is going to be something more like Reagan, who, if you'll remember, was dealing with really cheap autos coming in from Japan. So Katherine Tai saying, just don't bring it into the U.S. at all. Reagan at the time basically said, you can sell, but you need to come into the U.S. and you need to manufacture here. That could be kind of the nuance we see with the Trump administration, which, of course, is different than just saying, we don't want any of these cheap goods in our country.
Of course, then the national security concerns become a problem. Already the Biden administration said we have to be careful with these autonomous vehicles and some of the Chinese EVs because of the national security concerns when it comes to China. China is an adversary. Japan is an ally.
Have you noticed a change over the last week? How much less we're talking about the Federal Reserve, how much more we're talking about policy coming out of the White House? Let's stick with policy. US automakers under pressure. This on a Reuters report saying President-elect Donald Trump is planning to eliminate a key consumer tax credit for purchasing EVs. Bloomberg's Craig Trudell joins us now for more. Craig, share some of the news with us and how expected this all was, given the nature of the campaigning over the last year.
I mean, in terms of how expected it was, I mean, looking at just the Trump transition team's statement reacting to the Reuters report yesterday is pretty instructive. They essentially said, more or less, we said we were going to do this, we're going to do it. So I do think that this was, well telegraphed, but there was maybe some hope that with Elon Musk, cozying up so close to Donald Trump, that maybe he would have a change of heart and potentially change his tune on EVs. I think there were also some who said no. Trump will stick with this plan, but Tesla will be better positioned. I think, based on the market reaction yesterday, there was maybe a little bit of rethinking of whether or not that stands to reason, given Tesla sells more EVs than anyone else in the U.S. by a wide margin, and a significant number of its customers benefit from this tax credit.
Well, Elon Musk posted on Twitter that the U.S. should end all government subsidies, including TVs, oil, gas. I guess he's okay, Tool, when it comes to the electric vehicle subsidies, that we could see this trifecta in Congress repeal. But Craig, the other side for Elon Musk is going to be tariffs. How difficult are those going to be for his business?
I think that's actually a potential positive for him. It's not going to be without some issues, in the sense that Tesla does have a global supply chain, but they do have a significant presence in the U.S. market. They do try and insource a lot of components to some degree. Will it hurt? Potentially, but maybe not as much as, say if you're Mercedes or BMW, some of their competitors. GM and Ford, it's a sort of similar story, in Stellantis, where these are all companies that, over decades have outsourced a fair amount of their supply chain. But I think, the emphasis on reshoring and legislation like the Inflation Reduction Act has really led to this rethinking of whether or not we should be relying so much on components from overseas. And the pandemic, I think, really led to some rethinking in that on this front as well.
I remember when Joe Biden had the heads of GM and Ford at the White House to show off the EVs. If we do see this elimination of the tax credit of the subsidies for electric vehicles, how much money do you think GM and Ford are really going to still put into this industry?
I think it's a great question. I mean, I would say that of the two of them, I think GM is much further along in its transition. They have not been without bumps in the road over the last few years of trying to stand up a battery joint venture with Korean partners. They really struggled to get that off the ground, but they've really made some headway in the past few months, I would say. And brought in actually a very prominent former Tesla executive to oversee that business. They have a lot of EVs now in the market and more coming next year. Ford, on the other hand, I think both of them have sort of pumped the brakes a little bit in terms of how many EVs they're bringing, how quickly. But Ford is much further behind in terms of, I think they tried to kind of steal a march on GM and rushed out the Mustang Mach-E and the Ford F-150 Lightning. But those have not sold particularly well, and that business has not performed well at all for Ford. So maybe this does lead them to sort of rethink whether or not they should go, even slower to kind of shore up the profitability for that business going forward.
Well, for the pure EVs, Craig, the market is clearly voting a certain way, that Tesla can survive this, but Rivian cannot. You can see it in the market reaction this morning where Tesla is positive again. Can Rivian survive this? Can Rivian stay afloat? What do the economics become without an EV subsidy for them?
This company has had quite a week because we did have a sort of formalization of their joint venture with Volkswagen, where VW a few months back announced they were going to invest up to $5 billion into the company. They upped that this week to $5.8 billion. So we saw a big jump in the stock earlier this week. We saw a huge drop yesterday, and I do think that the amount of money that this company is going through, it's even more excessive than what we saw out of Tesla a few years ago. We've seen that in Tesla's case they were able to eventually overcome that. But what Rivian really needs to do is get to a point where it's making EVs in high enough volume that it really starts to see some benefit of cost. And perhaps this joint venture with Volkswagen is helpful in that regard. But I think that's also a partnership that's more so focused on software. So I don't know that they will necessarily see a huge boost from Volkswagen in terms of knowing how to put the trucks and SUVs together. That's really what's been sort of vexing them the last couple of years.
Well, it's this whole thing. Should the private market be the thing that carries these companies forward, or should it be government? Back in 2012, Craig, Mitt Romney criticized Obama for what he said was wasting money on a loser like Tesla. How should we look at that divide now as to whether the government should be taking risks on these EVs, or frankly, the industry has just moved forward and it's not time for that anymore?
I think that's such a great question. I do think that, if you look at the U.S. as sort of like a venture capitalist investor, they had a huge win in Tesla, right? And they bet on this company, managed to really support it through some tough times. If anything, the only reason that Uncle Sam didn't make out better is the fact that Musk, I think, was so sort of self-conscious about the extent to which he, kind of had his bacon saved by the U.S. that he wanted to pay the loan off early to kind of, do away with that criticism. We have, though, we should note, had several misses in terms of EV companies that EV companies or battery companies that the U.S. Has supported that have gone out of business. And that's the nature, though, of sort of this style of venture capital like investing. I do think that when we look at what has happened in China, a huge reason for why we've seen so much success in that country is the level of support and the consistent level of support. We just haven't seen either the amount of backing from the federal government in the U.S., but more importantly, I would say, the sort of waffling that we've seen from one administration to the next is not conducive to building a long-term healthy industry.
Hey, Craig, appreciate your input on the subject. Craig Trudell there of Bloomberg on the latest with the automakers. Tesla just about positive by a few tenths of 1% in early trading. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Scott Bessent, a top candidate for Treasury Secretary in the Trump administration, is calling for a return to Alexander Hamilton's favorite tool. In a new op-ed for Fox News, he says the truth is that tariffs have a long and storied history as both a revenue-raising tool and a way of protecting strategically important industries in the U.S. Bessent goes on to say that Trump adds the benefit of being able to use tariffs as a negotiating tool and that they're a way to stand up for Americans. Meanwhile, hedge funds reduced their exposure to tech giants like Amazon and Apple in the third quarter. That's based on the latest 13F filings, which showed holdings of Amazon dropped by $11 billion in the quarter. And almost twice as many investors cut their stakes in Apple than added to them. While not a hedge fund, Berkshire Hathaway also reduced its position in Apple by 25%. This coming, of course, as fund managers move out of growth stocks and rotate into other sectors that would benefit from rate cuts. And social media platform Blue Sky gained about 2.5 million users in the past week as users leave X. Donald Trump's election win and a change to X's terms of service is pushing people away from Elon Musk's platform. The change in terms comes into effect today. It requires all legal disputes related to the platform to be brought exclusively in the U.S. District Court for the Northern District of Texas or state courts in Tarrant County, Texas. Of course, conservative leaning. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes. I don't really understand the aversion to X at the moment. Just mute the words you don't like, follow the people you do like, and create your own sort of like little echo chamber if you really want to, and just use it that way.
Also, the interface of Blue Sky, I've tried it before. I'm like, you guys have had like 2 years to get this right, and you're not there yet.
It was also started by Jack Dorsey, who also started X, and then they parted ways. I think it's just because Elon Musk is so close to the former president.
That's it.
He has now, proximity to power, and people say we got to go somewhere else.
Okay, all right. Do whatever you want. It's free country. Up next on the program, you can't hurry cuts.
The economy is not sending any signals that we need to be in a hurry to lower rates. We're confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%.
So you'll just have to wait. From New York City, this is Bloomberg. Some breaking news for you in the last few moments. According to a person familiar with the matter, speaking to Bloomberg, Russian President Vladimir Putin and German Chancellor Olaf Scholz planning to hold a phone call later on today. Anne-Marie, the first direct communication potentially between the two leaders in almost 2 years.
That's right. He's been isolated, but from all these G7 leaders. What you see taking shape right now is this raw political power we have out of Mar-a-Lago. President-elect Donald Trump says he wants to end this war, and maybe that's why Scholz feels like he can get on the call with Putin.
One to watch this Friday, that's for sure. Under surveillance this morning, you can't hurry cuts.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve. We're confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%.
So here's the latest. Fed Chair Jay Powell saying the FOMC is in no rush to cut rates further, citing continuing U.S. economic strength. Powell's comments prompting traders to pull back expectations for a December reduction. Michael Kushma of Morgan Stanley writing the surge in yields post-Fed rate cut was unusual, but strength in data whipsaws the Fed once again. These are the challenges of being too data dependent when data is very noisy. December is getting more debatable. Michael joins us now for more. So, Michael, base case, is this a pause or a cut?
I think they're going to cut, but it's going to be characterized as not as a continuation to expect this continuously, but reflecting, again, the recalibration of monetary policy to a more appropriate level, given the current position of the economy, but will not portend more rate cuts automatically next year.
Michael, something Anne-Marie and I have been talking about this morning is the politics, the optics of what it would look like if the Fed pauses in December right before a Donald Trump comes in. Do you think that's playing on the Fed's mind at all?
I don't think so. I think they are very, very data dependent. In fact, I think they've been whipsawed over the course of the last, year and a half with data moving up, moving down. And we saw earlier this year in late spring, early summer, where they were getting nervous about maybe not cutting rates at all because inflation was kind of surging in the second quarter. Then, of course, when they took back some of the rate cuts they might expect to do, inflation turned around and went the other way. So, no, we're going to do, 3 rate cuts this year anyway. So I don't think that is a key factor in their decision at all. They're going to follow the data. And the data, as Chairman Powell talked about, is still pretty good overall. There's no reason to rush rate cuts. We can recalibrate it because inflation is substantially lower than it was when interest rates were higher.
Well, to be fair, the bond market recalibrated before he did, Michael. I mean, it's been this pendulum swing back and forth. Before, up to this moment, the market had been pricing in a substantial amount of cuts. We get strong data. We get an election. It pulls back. We're pricing in about 225 basis point cuts up to the summer of next year. Where do you make where this pendulum is? Are we in a good place? Is it going to swing one way? Have we swung too far? Where do we stand?
I think the economy is in a really good space, and it's moving around. Data moves around, but underlying, GDP growth, even employment growth, is back to reasonable levels. Everyone expects. The consensus expects a reasonably strong deceleration of growth next year. We haven't seen that over the last several years, but it's likely that the Fed does respond to a deceleration of the economy if it's meaningful in terms of raising the unemployment rate. But other than that, there's no reason to rush. There are no big imbalances. The household sector is in good shape. The corporate sector is in good shape. Data will bounce around all over the place, but 10-year bond yields haven't moved all that much. We were at this levels in, I think it was June 30th. We were basically at 4.3, 4.4%. We rallied in Q3, and now we're back up at the same level. We're only up like 40-some basis points over the course of the whole year. So long-term yields aren't moving around all that much, despite all this bouncing around in the economic data.
Well, we did have yields pushing higher on the 10-year, and that's because the market has been pricing in more policy changes out of Washington, D.C. Powell said yesterday we have to see the economic outlook evolve. So what policy risk are you potentially looking at for 2025?
Well, again, I think a lot of the Trump agenda cuts two ways, and tax cuts are good, but tariffs are bad for economic growth. I think back in 2017-18, when the tariffs were first being imposed, I think global PMI manufacturing PMIs peaked just as tariffs were being imposed in the economy. Manufacturing sector decelerated a bit, and the Fed was talking about rate cuts not too long after that. So I think his whole agenda cuts multiple ways, and I think tariffs in many ways are ways to raise revenue to finance tax cuts on other things. The net balance of all these things, we're not sure. I'm more concerned about the labor market, that if there is a deceleration of labor supply in the economy, that will reduce the potential growth next year as well. So there's lots and lots of cross currents at work, which makes it more challenging to see, well, will there be a deceleration like the consensus thinks, or is the economy has such strong support from household income growth and CapEx spending that it will be just fine, growing 2%. What's wrong with that?
Michael Kushma, appreciate your time, sir, and the input. Michael Kushma there of Morgan Stanley. I think you can construct an argument over the last few months that the Fed's easing bias has contributed to high yields at the long end. Might sound counterintuitive, but I think you can make that argument. And I just wonder, now we've chipped away that easing bias, particularly just yesterday in the comments from Chairman Powell, whether that helps to stabilise the long end, just put a lid on things just for a moment. That's the latest on fixed income and on the Federal Reserve. Coming up in the next hour on Bloomberg Surveillance, we'll catch up with Ross Mayfield of Baird. We'll speak to Frank Lee of HSBC, Steve Ricchiuto of Mizuho, and Rob Waldner of Invesco from New York City. This is Bloomberg.
Generally speaking, the Fed is still on board with this gradual easing cycle.
We still think the Fed actually still moves lower next year, even if they do it at a slower pace.
We are likely to see another 25 basis points cut in December.
The market will be okay as long as it's a growth story. But I think at the end of the day, the growth story is actually the important one.
Any growth uptick that we might see next year will circumvent any of those headwinds. So that's the way that the market has been behaving.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell in New York City this morning. Good morning to you all. Equity futures right now negative by 0.5%. The scores look like this on the Nasdaq 100. We're down by 0.75%. Your day ahead, 8:30 Eastern Time. U.S. retail sales. Looking ahead to that after CPI, PPI and jobless claims keep this Federal Reserve at the moment just a little bit cagey about reducing interest rates at the December meeting. We heard from Susan Collins, the Boston Fed president, in the Wall Street Journal this morning. It's not a done deal.
It's certainly not a done deal. And Powell, basically everybody we've heard from, let's be honest, be it Collins, be it Kashkari, be it Logan, are giving themselves that optionality heading into December. You see the market moving off of that pricing. I got to say, John, it does feel like the good old days where this market is reacting to macro data and to Fed speak.
Which is why retail sales is also going to be incredibly important in 30 minutes' time. Paul Donovan was talking about the U.S. consumer back on display today ahead of the holiday season. Spending should reflect economic reality, which is of notable improvement in living standards, not economic perception, which is somewhat soured, which I would say we saw in the election results.
Going into that retail sales data, bond yields lower across the curve, particularly the front end. On a 2-year, we're down 4 basis points at 4.30. On 10s, we're stabilizing around about 4.43. Coming up this hour, we'll catch up with Ross Mayfield of Baird as traders dial back December rate cut bets. Frank Lee of HSBC on why Nvidia's AI train ride is showing no signs of slowing down. And Steve Ricchiuto of Mizuho on why he thinks the 10-year could creep back towards 5% in 2025. We begin this hour with stocks on track for a losing week. As traders digest Fed Chair Jay Powell's hawkish remarks, Ross Mayfield of Baird staying optimistic, writing the bull market is set to continue into 2025. Near term, sentiment is likely the biggest risk, animal spirits returning to markets. Survey data is bullish and positioning is risk on. Ross joins us now for more. Ross, welcome back to the program. I want to start with the Federal Reserve and what you thought of Chairman Powell's comments yesterday and whether you think they're setting up to pause in December.
I think they are, but I would caveat it that we still need to see that that labor market data first. The last report, non-farm payrolls, was obviously very messy. Hurricanes, strikes. So there was a lot to digest there. I think that one more sour labor market report could put a 25 basis point hike back on the table. Absent that, though, I think the economic data has been strong enough to warrant a pause and let them get started in 2025 with a cut in January.
Ross, that strong data has led to higher bond yields. Those higher bond yields, some people are making the argument, has started to constrain equity markets this week. The rally has lost some steam. Do you put any weight on that argument?
Yeah, absolutely. Outside of sentiment getting away from us, I think probably the biggest risk to markets right now over the next 3 to 6 months is just higher long-term bond yields. You know, we've seen even in this bull market that pushing up through 4.5% on the 10-year towards 5 has been a weight. Even if it's for the right reasons, at a certain point, those higher yields constrain equities. I think that is a risk. So we're glad to see it. I think it is because economic data has been strong, but to the extent that it pushes the Fed way out into the future, you know, markets are going to be a little more volatile. I don't think it's cause for a 10% sell-off or anything like that, but it certainly caps the upside here.
We've certainly seen that volatility in treasuries, Ross, in a way that historically we haven't. Bank of America's Jared Woodard wrote that, in our view, treasuries are just for trading. Consensus 60-40 portfolios that hope that bonds would be a hedge that only worked in a 2% world of record low inflation. Is he right? Are treasuries just for trading now?
No, I don't think so. I mean, for most of our clients, treasuries at this point are for income, right? I mean, for 15 years, you couldn't get 4.5%, 5% on something as safe as a 10-year treasury. We had clients who would stretch way out on the credit spectrum, look to high-yielding equities to get that income portion of the portfolio to support them in, you know, retirement or later years of their investing careers. So I think treasuries can definitely be for income. And I think at a certain yield, they can be a hedge as well. I do think that 2022 was a wake-up call that stocks and bonds can go down at the same time. But I don't think the 60-40 portfolio, even if constructed with something as safe and simple as treasuries, is anything close to dead over the next 5-10 years.
But one of the big arguments for owning treasuries has been reinvestment risk, that yields are going to come down and you have to get into this market. Ross, that isn't what has happened. Yields have been pushing higher. What does that do to an investor psyche that has been told that so frequently? Does that cause more of an aversion to jumping into the treasury market this time around?
Yeah, it's certainly possible. I mean, the headline yield, I think, is the first thing people see. So looking at the 4.5%, 5% yield on a 10-year it is attractive. Now, obviously, seeing your portfolio down, your prices down, has been a real gut punch for our clients over the last couple of years. You know, when bonds had basically been in a bull market for 40 years. I think the other thing is we have a lot of people on the personal finance side of things who are waiting for rate cuts to look to something like a mortgage rate to refinance, and instead you've got the 10-year yield pushing up higher. So I do think there is kind of a disconnect in the bond market right now. I think it'll be rectified somewhat in 2025 as we get clarity on the Fed's path, though.
The other play that's had a lot of false starts is diving into Europe, Ross. And Barclays points out that Europe versus the U.S. has had a record underperformance year to date. There's this other argument starting to form that maybe because of the economic weakness in Europe, this is, again, Bank of America's argument that you're going to get a lot of cuts and you should be buying Europe. Ross, can you be buying Europe right now?
If forced to make a choice, I would still prefer the U.S. over Europe. I think that the sector concentration is better in the U.S. You've got more growth, you've got more technology. The problem with Europe over the last 10 to 15 years, or at least one of them, has been that the sector concentration is sectors that haven't been working. It's more staid, it's more staples and energy and things that, quite frankly, we don't expect to work as well as tech and consumer over the next year plus. So you also have the strong dollar story to contend with. Clearly, the market thinks that Trump is going to be a strong dollar president. That's a headwind for internationals. So I don't think you need to get out of Europe entirely, but if forced to make a decision, I would still prefer U.S. markets over Europe.
Danny, you need a lot to change in Europe and change pretty quickly. Think about what needs to happen here. We've got a call potentially between Putin and Scholz. That war needs to end. 1. 2, you need to see Germany turn around and take some real economic leadership and loosen the purse strings. That might happen. If those things start to line up, then maybe you can construct an argument to say, OK, given what's priced, which is not much at all, things can get better.
The Germany piece is just such a large question mark, though, with an election coming up, which, by the way, is going to coincide with Trump coming into office. There isn't clear leadership there at the moment. But I mentioned Bank of America, Michael Hartnett out today saying buy Europe ahead of the inauguration, purely and simply on the fact that the ECB is going to be cutting rates. That's maybe more tactical, though, and less of a big structural change for Europe.
They're going to have to ease big time. They have gone from worrying about inflation to maybe, and I think Deutsche Bank was the first to say this, the prospect of disorderly disinflation, because things could go the other way so quickly. But I'm with you. When it comes to Europe, there's big structural problems in Germany. Massive structural problems. Anne-Marie, we've talked about this for years. Security, relying on America. Energy, relying on Russia. Economics, relying on China. Every single one of them has major cracks in now.
And they enslaved themselves to cheap Russian gas. So when the war happened, this is the problem for their manufacturing base. They're paying a lot more for their energy infrastructure that they need. And then you saw this U-turn from the German government saying maybe as a collective bloc, we need to start thinking about energy security. But they weren't thinking about that when they were the ones benefiting from that cheap gas.
And I think we have to remind people that President-elect Donald Trump is not the source of the problems for the Europeans. These are choices the Europeans made. What President-elect Donald Trump is doing is accelerating the process for them to actually have to find solutions and find solutions quickly. This is policy in Europe. We need to talk about policy in America as well. Ross, can we finish there? I want to understand your underlying assumptions on sequence, on timeline, on size. Ross Mayfield of Baird, I'm now told, is gone. He's now logged off from the conversation, so maybe he didn't want to carry on that conversation. So we could carry on that conversation. Sequence, timeline, size. We had Isaac Boltansky of BTIG join us a little bit earlier this morning, and he was talking about how aggressive the timeline would be for Republicans because they've only got 2 years.
I got to say, Isaac shocked me. So what I'm hearing from people is that they think this deal can get done in 2026. To Isaac's point, though, maybe the actual signing or the voting starts a little bit later down the year. But he says once these cabinet appointments are in place, even now they're talking about what needs to happen in terms of pay-fors to get these tax cuts over the finish line.
The market needs to know this timing. And of course, before it needs to know the timing, it needs to know who Treasury Secretary is. And I think that gives us some sort of shape about priorities, because it is a market that is looking through tariffs, at least for the moment. If you do get what Isaac is saying, and they're straight out of the gate with things like tax cuts, that will obviously be market positive and maybe allows this rally to carry on. If that's not the shape, it could change on a dime.
Treasury, Commerce, Energy, NEC, SEC, FTC. These are the names we're still waiting for the financial markets to really understand President-elect Donald Trump's priorities.
Why did Russ run away? Equity futures right now on the S&P down by about 0.5%. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Two of Elon Musk's companies are moving to secure multi-billion dollar increases in valuations through new deals. According to the Financial Times, SpaceX is gearing up to launch a tender offer that will sell existing shares in the business at about $135 each. The sale would value the company at more than $250 billion. Meanwhile, Musk's artificial intelligence startup xAI has reportedly raised $5 billion at a valuation of about $45 billion, nearly double its valuation from a few months ago. And sources are telling Bloomberg Russian President Vladimir Putin and German Chancellor Olaf Scholz are planning to hold a phone call today. The call is the first direct communication between the two leaders in almost 2 years. It comes at a critical time for Ukraine as the country braces for the third winter under attack from Russia. Uncertainty over Ukraine's support from Western allies has also been growing ahead of Donald Trump's return to the White House. And Donald Trump and his incoming policies have been the topic du jour at the APEC CEO Summit in Peru. Speaking with our own Lisa Abramowicz, JPMorgan CEO Jamie Dimon suggesting that the impacts of Trump's proposed tariffs may not be as damaging as many have feared.
He's not against trade. He thinks a lot of these things have been unfair against the America. And there are examples where that's true. If they do it, it'll be judiciously, intelligently applied. And, by the way, it'll get people to the table. Read his book. I create options. He's going to create the option. I just hope it's done wisely.
Trump yesterday ruled out Dimon for a role in his next administration, but praised the CEO for his, quote, outstanding service to our country. That's your Bloomberg Brief. John?
Yahara, thank you. This was never a thing. How did it become a thing?
Because our colleagues asked the former president, when he was the former president, before president-elect, would you consider could he be a Treasury Secretary? He said, sure, I'd consider him. There's a lot of people under consideration.
Jamie Dimon made it a thing. He wrote an op-ed in the Washington Post that Republican or Democrat, they should have private business in the White House.
So he was kind of flirting with it, right? And at the same time, then he turns around and says, I don't want a boss.
Well, I think President-elect Trump liked what Jamie Dimon said at Davos, which was Trump was right about a lot of things. He was talking about things like tariffs. He was talking about things like NATO, telling the Europeans you need to spend more, get to the 2% of the budget that you're supposed to be contributing. And then that sort of took on this whole story that we're still talking about today.
I'm pleased we can put that story to bed. Up next on the programme, the Morning Calls Plus, Frank Lee of HSBC on why NVIDIA's AI momentum can only keep growing. That conversation up next. From New York City this morning, good morning. US retail sales at 8:30 Eastern Time. This from BMO's Ian Lingen. Would we be shocked by a negative print? Not at all. However, it is in our base case scenario, leaving us biased to see the current consolidation continue as opposed to expecting a more dramatic fall in 10-year yields. Well, here is your 10-year yield this morning, and good morning to you. We're down a single basis point on the 10-year to 4.42. In the equity market, we're negative by about 0.5%. Let's get you some morning calls. First up, Wells Fargo upgrading Morgan Stanley to equal weight, expecting shares to benefit from a rebound in capital markets activity. Their stock is up by 0.4%. Next up, Morgan Stanley downgrading Solar Edge to underweight, seeing numerous question marks under the incoming Trump administration. We're down another 4.4% in early trading on that stock. And finally, RBC hiking Tesla's price target to $313. Highlighting optimism on the car maker's autonomy goals and its advantage in the automotive sector. That stock is up by about 1/3% in early trading. Turning to NVIDIA, Frank Lee of HSBC raising his price target on the chip maker to a joint street high of 200, writing, we have pondered this amazing growth trajectory, and not only do we see no signs of a slowdown, we expect further upside in 2026 data center momentum, which in our view is still not fully priced in by the market. Frank joins us now for more. Frank, welcome to the programme, sir. I just want your opinion on what's behind that train and why it doesn't slow down anytime soon.
Sure. I think it's, every couple of months, everyone, I think, goes through the same question of, can NVIDIA continue on this amazing growth trajectory? It is now approaching kind of uncharted territory in terms of the market cap of the company. But what we continue to see is that the overall spending on hyperscaler CapEx continues to go up. Since May, we've noticed there's been a 20% upward revision in the overall street consensus view for the 4 major hyperscalers. If we look at that in terms of potential server capex next year for AI, we think that's going to be more enough to cover NVIDIA's growth, at least for the going into next year.
Frank, we've got to talk about the source of that demand and how strong you believe their biggest customers are, and whether those customers you think have demonstrated and done a good enough job of justifying their investment over the last few years. Do you think they're doing that?
Yeah, no, I think that's a great question. I mean, the question everyone comes back to is, there's the investment that's going on, what's the return, what's the monetization? It is a fair question, and it's not a question that I think has been fully answered. But I think from what we can see is that the spending continues, and into 2025, there's no sign of any slowdown. And we've also seen, I think, collaboration from what we're seeing on the supply chain in Asia. We continue to see many companies out here that continue to see upward revisions from the NVIDIA supply chain. So it seems to be going hand in hand in terms of the investments we're seeing from the hyperscalers, as well as we're seeing in the supply chain.
But just given that, Frank, I mean, is there not some form of concentration risk for NVIDIA when Microsoft makes up nearly 20% of your revenue, Meta another 10? Aren't these real risks if any of them pull back even slightly?
That's a good question. I think, the concentration risk is still there, but it is diversifying. So as an example is, if you look at the enterprise, which is the non-hyperscalers, right, they're becoming a bigger and bigger part of this market. If you look at 18 months ago, I would say hyperscaler spending is probably 80% of the market. Now it's probably looking to be about 60% of the market. So while it is still a very high concentration, that risk is coming down. You're seeing further expansion into the corporate world in terms of spending there. So that's what you see companies like Dell, which are traditionally not leveraged to the hyperscaler growth. They're seeing very strong growth trajectory in AI as well.
So Frank, we're going to hear from the company in about 5 days' time on the 20th for their earnings. Options market's pricing in something like an 8% move either way. What sort of fireworks are you expecting on the day?
Yeah, I mean, I think they will have a beat on their revenues. We expect they'll beat on the current quarter, as well as give a better guide relative to consensus. That being said, though, the share prices have had a very good run into the earnings, and so whether that's going to be enough to really give the market an extra boost, I think it still remains to be seen. But I think we're taking the view that it's not just the next 2 quarters, but if you look at all of next year, we do feel that confident that there'll still be further upside in terms of the market expectations.
I wanted to ask you about what was going on with the DOJ. They sent subpoenas to NVIDIA in September. For NVIDIA, do you see a change of an environment with the election and potentially what policy regulation could look like for the company next year?
I think it's there's going to be a lot more probably uncertainty and noise now, but I think it doesn't change the fundamentals. The fundamentals is that the company's dominant position in AI is unchanged. We don't see any immediate competition. In fact, I think the hyperscalers themselves, who have every interest to try to develop their own chip to reduce their dependency on NVIDIA, is not able to do that. In fact, I think some of their own chips they're designing, the momentum is actually slower next year. So it shows you that in terms of being able to compete, we still don't see anybody narrowing that gap yet. So I think the fundamental outlook's not going to be changed. There will be probably a lot more, I think, just headlines. But I think if you just look at the overall earnings growth and expectations, I think that remains largely unchanged.
What about outside the United States? Geopolitical concerns, especially when it comes to the fact that the chips are made in Taiwan, and we have a president-elect who's very hawkish, and his rhetoric is very hot when it comes to China.
Yeah, so I think, if you think about the China exposure for NVIDIA as a whole, it is coming down. At its peak, China was probably more than 20% of its revenues. It's now at a point where I think China itself is only going to account probably for somewhere around 10% of its revenue. So it's come down in terms of that as being an end market. As far as I think where the chips are made, I think that's not something that's going to change in the near term. The TSMC is building factories in the U.S., but it's going to take some time before they're able to build increased production there. So I think reality is that while there's going to be some rhetoric around it, it doesn't change the fact that the manufacturing base is going to still stay in Taiwan, given the dominance of TSMC, and that's not something that's going to change in probably anytime soon.
Frank, when it comes to the politics for the CHIPS Act, out of $123 million, a total of $33 billion out of a total of $33 billion for the CHIPS Act, only $123 million has been announced. As we head into the twilight of the Biden administration, what sort of pushes do you expect them to make with the CHIPS Act? Can anything else get done?
Yeah, there's not going to be that much time left. And I think if you think about, the CHIPS Act, there hasn't been that much money, as you said, as you pointed out, actually been given out. I think where the majority of the CHIPS Act, associated CHIPS Act, that's helped companies like Intel has been the tax credit. So they've been able to get, I think, the advantages on tax credit, but they haven't really gotten enough subsidies. In fact, no one's really has. So I think if you think about, I don't think it changes the calculus of things. I think at the end of the day, the onshoring trend is going to continue. It will continue to take time, but I don't think it really changes, the trajectory where, the people will be looking to change their investment cycle. I think the longer term geopolitical events is here to stay, and I think companies are going to build regardless of how much funding they get.
Hey Frank, good to catch up. Appreciate it. Going into Nvidia earnings a week away. Frank Lee there of HSBC. That stock is down slightly this morning, but up big time over the last few years. Some reporting from Jeff Stein over at the Washington Post. The Trump Treasury hopeful Scott Bessent expected to meet with the President-elect Donald Trump today in Florida, according to sources. Bessent, of course, #1 for the market right now to become the next Treasury Secretary of the United States.
Certainly, if you look at the betting odds, it's Mr. Bessent's to lose. He looks like he's going to be the front runner. Looks like he's potentially going to be the winner. It does look like now this means Donald Trump has moved on from some of the other nominations, and he's going to be honing in on the economy. Also interesting this morning, Scott Bessent is penning this opinion piece in Fox News saying, let's talk about tariffs.
I will just say yesterday when RFK Jr. was announced, poly-market betting on Scott Bessent tanked. It kind of went back up, but I think there is just this slight hesitancy with some nominees coming out of left field. Will it be the market's favorite?
Universally seen as a solid candidate for the post. From both sides, actually. You see in the body of this story that comes from the Washington Post today that it's the likes of Jason Furman, which of course served under President Obama. It's also, according to a source apparently, Jamie Dimon, an endorsement from him as well. Even Steve Bannon in the mix saying that it should be Scott Bessent.
So that would say that this is an individual. If you're dealing with potentially some other controversial picks and difficult, controversial Senate confirmation hearings, this is someone that potentially will be able to get that bipartisan support, similar to Secretary of State Marco Rubio.
We'll see how that meeting goes a little bit later on today, potentially. Equities right now on the S&P 500, negative by 0.5%. The next stop for this market, U.S. retail sales. We've had a drip feed of data over the last few days. CPI, PPI, jobless claims, and all of them just eroding the Fed's perceived easing bias, particularly given the comments we heard from Chairman Powell just yesterday afternoon. So up next on the programme when that data drops, we'll hear from Steve Ricchiuto of Mizuho, and we'll get the thoughts of Rob Waldner of Invesco, who will be here to react. With stocks just a little bit lower in the bond market, bond yields yesterday at the front end a whole lot higher. This morning down by 5 basis points. The 2-year 4.29 on a 10-year down a basis point or 2. We're trading around 4.42. From New York, this is Bloomberg. Seconds away from retail sales data in America, about 60 minutes away from the opening bout, with equity futures on the S&P 500 negative by 0.5%. On the Nasdaq 100, we are down by 0.9. The scores in the bond market going into that release of retail sales in America looks like this. Yields down at the front end on a 2-year to 429.48. We're down about 5 basis points there. Down a single basis point on 10s to 441.58. With that economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Better than expected news on retail sales. A little bit stronger spending by Americans. 0.4% increase on the headline for the month of October. The ex-autos comes in at 0.1%. Ex-autos and gas the same. And the retail sales control group, which is what people really care about, is actually down by 0.1% after a 0.7 gain in September. Import prices come in up 0.3%. Import prices without petroleum, 0.2%. 0.2%. Both of those stronger than expected. So it just continues this pattern that we have seen of a little bit of an inflation issue ongoing. And then the Empire Manufacturing Index, this is a go-figure number, up 43 points to 31.2 from negative 11.9. So an awfully strong number there in terms of New York manufacturing. New York manufacturing, of course, not all that important to the overall numbers, but still quite interesting. Taking a quick look at what moved in the markets or in the retail sales report. We had 1.6% gain in motor vehicles, building materials up 0.5%. We expected strength there, obviously, because of hurricane rebuilding. Clothing stores down 0.2 points, and we saw apparel prices collapse in the CPI and PPI, and general merchandise stores up 0.2%. So it looks like a fairly standard kind of spread out spending during the month of October. Doesn't look like anything particular stands out here.
Mike, can you just help us explain that difference between the headline beat and then the control group miss? What explains the difference between the two, just at a first look?
Well, first look, it would be that motor vehicles probably come in stronger than anticipated. The number of cars sold, the monthly seasonally adjusted total is what goes into GDP. So it's a little bit of a confusion there. Gasoline prices also go into the headline number. They were up only 0.1% because this is reported in dollar values. So those two things are going to have an impact on the headline, whereas the control group is basically your department stores, specialty stores, the retail stuff that you and I buy, and that's what goes into GDP. So economists pay more attention to that than they do to the headline number.
How noisy does this data start to get, Mike, heading into the holiday season? Is any of that captured in what we see today in this data?
No, it doesn't look like it because this was October, but we do start to see it show up in November. Even though Black Friday is what people think of as the kickoff, we've seen a lot of spending move backwards into November, and you'll see a lot of advertisements from retailers trying to push spending out over the months of November and December. So, yes, it gets a little harder to separate out what the holiday spend is, but it is seasonally adjusted, so we get some idea of what the differences are. But we are, at this point, you'd have to say, looking at this, there's no reason to think we're going to have a bad holiday season.
And Mike, I hear you've got an interview in about 2 hours' time. Can you walk us through what the big topic will be?
Well, I am here at the Boston Federal Reserve Building, so we're going to have the boss, Susan Collins, the president of the Boston Fed, talking with us. And we're obviously going to try to get some guidance on what the Fed is going to do next. A lot of questions about whether this stall in inflation is going to keep the Fed sidelined in December. Jay Powell opened the door for it yesterday. So that'll be among the chief questions. And we'll find out what people are telling her here, what the CEOs in the first district of the Federal Reserve are saying about where they see the economy going.
Looking forward to it, 10:30 Eastern Time on Bloomberg TV. Michael, thank you, sir. Mike McKee there with retail sales. A beat on the headline number on US retail sales. Yields resume the climb. On a 10-year yield at the moment, we're higher by 2 basis points. The equity market near session lows on the S&P. We're down by 0.6%. On the Nasdaq 100, we're down by 0.9. Joining us around the table is Steve Ricchiuto of Mizuho. Steve, good morning.
Good morning.
Your thoughts on the data, please, sir?
Well, I think the most interesting aspect, rather than the headline numbers, was the revisions to last month. The headline number went from 0.4 to 0.8. The control group number, which is the critical number, went from 0.7 to 1.2. So if you take out 0.1 after 1.2, you're still up 1.1%. It's a pretty healthy environment. And you're looking at September, which actually is more important than the month of October when you think about quarterly average data, okay, because the level that you set at the end of the previous quarter really sets the average for the next quarter. And therefore, you've got this big jump in the September period. And I think that sets the stage for a very, very healthy fourth quarter GDP number on top of several quarters of very healthy GDP.
Does it set the stage for a pause in December?
To be honest with you, the Fed should not have done 50 basis points. They should not have then been forced to come in and validate it with 25 more. The Fed is ahead of the curve in terms of what they knew relative to the economy, relative to the inflation story. So, yeah, they shouldn't do it. Will they or will they not? We'll see. But the reality is what they're doing is a mistake. Bond yields are up. up since they began cutting rates. That should be the message for them. Whether it's down a tenth or two, day to day doesn't matter. We're up, 50, 60 basis points? That's a message.
What is the risk? What is the risk if they keep cutting when maybe they shouldn't have even started to begin with?
Well, again, the situation you have to understand is the risk is to the market less so than to the economy. If you ask most Americans, do you really care between 2 or 3%? The answer is no. If you ask a bond investor that's yielding, 360 at the time, well, what's the difference between 2 and 3%? And the answer is, well, that's 4 versus 5. That's a big move in the bond market. And that's the critical difference. It's not for the underlying economic environment. It's for the bond market. The problem has not been the Fed for the economy. The problem has been the Fed and the way the market has been pricing it. And therefore, it opens the markets to risk. And when you've got an equity market that's very, very healthy against good earnings, there's no doubt about that, but not as good as they were, and projections of very strong earnings for next year, you have to ask yourself a question. Does the interest rate adjustment from 4% to 5% lead you in a position where maybe equity valuations need to move sideways for a while?
I want to talk about the power of this bond market, because, Steve, you said something to me last week that I've been thinking about ever since, this idea that everybody is an indexer in this bond market and that the bond vigilantes have gone away. Can you expand on that and just what the bond market can do in terms of pushing around either fiscal or monetary policy?
It really becomes harder and harder to do it because the reality is most investors are tied to a duration target because they're indexing. And therefore, their ability to move around that index is limited because the fact of the matter is if you perform with the market or you slightly outperform the market, you keep your job. If you slightly underperform the market, you lose your job. So the reality is you try to stay as close to benchmark duration as possible. From the hedge fund perspective, let's be honest, they've moved out of just playing plain vanilla Treasury securities and interest rate swaps and things of that nature. They're much more sophisticated in terms of structured product. They're much more sophisticated in terms of corporate product. They're much more sophisticated in terms of private equity investments. So therefore, are they paying as much attention as they used to pay to the Treasury bond market as well? Or do they look at the Treasury bond market and say, if I stay long over here and I keep long-term rates down a little bit over here because there's no risk capital on the street, well, does that improve the entire rest of my portfolio? They're in a position now to make those calculations. And therefore, you wonder whether or not the bond market is giving you the feed, which is why I think the Fed always makes a mistake when you try to use bond market indicators to tell them where inflation expectations are.
You say the bond market is telling this story and it's flashing red that the Fed shouldn't be cutting. When you look at the bond market and yields going up, is that because of underlying economic data or people pricing in policy changes of next year?
Well, the reality is the Fed funds rate should go out to the 2-year note. This concept of everything between the 2-year note and the 10-year note being a term premium, that's just a different way of saying it's an inflation risk premium. How confident are you that the Fed is going to get to that inflation target? So therefore, what you're seeing between 2s and 10s, to me, is inflation expectations and inflation risk. And I think what the bond market has been taking on board is we were so confident, or the bond market in general was so confident that we're going to be able to maintain 2% because we have global excess supply and we've got a declining goods portion of the equation. But by the same token, we have a service sector and a tight labor market that's leading to wages. So maybe there's more upside risk in inflation than we thought. So maybe we have to put in a little bit more inflation premium there.
How much does the December meeting, Danny and I have been talking about this, become political? Either political in the sense that they pause because they're not sure of the policies for next year, but also political in the sense that if they do pause, it means they would have cut before a consequential U.S. presidential election.
Well, I think the moving 50 required them to go in November, okay, because then they would have looked political. So therefore, they moved in November. Now in December, you can assess and say, OK, we've gone 75 basis points. It's time to look against the data and decide whether or not we need to go. And the reality is, the chairman actually said a few weeks ago that, we're still trying to figure out where neutral is. And the bond market had been so convinced, and the dots had implied they thought neutral was 3%. The market's now settling in at 4%, which has been our neutral number all along. And my big concern is, maybe given the stimulus that we have in the economy, you've got to assume that Joe Biden is going to forgive a lot of student debt between now and the end of the year, because this is the one major lasting legacy he's going to be able to do. Because once you've forgiven the debt, you can't go back and say you owe it again. So the reality is you may get a lot more fiscal stimulus before the end of this year, and the whole CHIPS component that hasn't been spent. So you're in a situation where maybe 4% is the long-term neutral, but maybe we need higher than that in the near term. So maybe the real surprise is that the front end continues to price in less less and less rate cuts.
So you think they might be done already?
I don't think they should have been moving as quickly as they did.
I'm just trying to put you on the spot. And
I think they should be done, yes.
Okay. Appreciate it. You've been consistent about this, and the market's moving your way. That's for sure. Thank you, sir. Steve Ricchiuto there of Mizuho. If you are just joining us, data out moments ago, retail sales have beat on a headline number. As Steve really looked at this, he said, look at those revisions, really strong revisions, and off the back of that, bond yields a bit higher. Joining us now to continue the conversation, Rob Waldner of Invesco. Rob, your thoughts, sir, on the totality of the data, as the Fed might say, this week. CPI, PPI, claims, and just moments ago, US retail sales.
Well, there's no doubt, Jonathan, the data's been pretty strong, both on the economy side, this retail sales number was stronger, and also on the inflation side. Don't forget, we've been getting several higher than expected core inflation prints. You know, we've had 3.3s in a row on a month-to-month basis. And I think that's what's got the market in the last month and a half kind of really taking out Fed cuts out of the pricing.
We've really taken out Fed cuts. Rob, has it gone far enough? We were just hearing from Steve Ricchiuto, who said that the surprise could be on the front end, pricing it out even more. Would you agree with that?
I disagree with Steve. I think it's taken out too much, actually. You know, we've had these cycles in the economy recently where you get a series of strong data and then you get weaker data. And, you know, we're in a cycle now where we've gotten a bunch of strong data. The narrative is switched to be all about strong data and fiscal risks. And it's always paid to trade against that narrative when the narrative gets too far one way. And if you go back and listen to Powell yesterday, he said, we believe we have inflation under control. We are going to get rates down to what we think is neutral. He thinks neutral is somewhere closer to 3.5. And he did acknowledge they may slow down, but he didn't say they were going to stop. So I think they're on a path to continue to cut rates. We have just more than 50% price for December now. That's not very much. We don't have that much price for next year. So, you know, we think that we think the inflation problem really is in the rearview mirror. We think it's shelter that's holding inflation up now, and that will come out. And when that comes out, it will become clearer that the Fed is right and Powell will continue to cut rates. And the market's not priced for that right now. The market has really been taking this cuts out. So while we were, you know, pretty negative on treasuries tactically at 3 3/4 or so, you know, we think treasuries are a good buy here.
Rob, do you think, and I want to understand how you think about the bond curve, there are some people who believe that the Fed's easing bias actually contributed to higher long-end yields over the last 6 weeks. And there are some people who believe this morning, with your call to go into the long end, but for very different reasons, they believe that as they erode that easing bias over the last few days, that may actually limit the climb on the long end, on a 10-year yield. Do you put any weight on that argument?
There's definitely some value to that argument, Jonathan. If you go back to the surprise rate cut of 50 basis points, we pivoted the yield curve steeper, right, on that announcement. So that pivot of the Fed towards easier financial conditions led to a steepening of the curve. That, however, does not mean that's the only driver here. We continue to acknowledge that the best overall way to think about the level of yields in the U.S. is to think about how much is priced into the Fed. So when you go back to when, you know, the treasuries were at 375 over a month and a half ago, 10-year treasuries, we had successive rate cuts priced into the market. What's really driven this move from 375 to 440 or so is taking out those cuts. There could be some impact. The curve is a little bit steeper, and 2s, 10s is steep now, but the biggest driver is rate expectations from the Fed.
And of course, so much of that, Rob, comes down to where neutral is. I wonder what you make of the Dallas Fed's Lori Logan talking about this week, saying that she sees substantial signs that the neutral rate has increased and some hints that it could be close to where the Fed funds rate is now. Do you think we're going to hear more Fed officials saying something similar to that?
I doubt we'll hear a lot of Fed officials saying that. I think that she may be acknowledging we don't think neutral is not something that's set in stone and never moves. It depends upon what the underlying momentum, what the potential of the U.S. economy is. And we know with the productivity growth that we've had and with the boost to the labor market that we've had coming out of the pandemic, neutral is probably a little bit higher. But in our view, neutral is traveling back down to a more longer-term neutral level, which would be close to 3.5, which we think that's also where Powell thinks it is. But I think it is clear that, neutral is not something you could just set in stone and leave there forever. It is dependent upon the factors that are driving the economy.
And very difficult to observe. Rob, thank you, sir. Rob Waldner there of Invesco. We're all making this up as we go along. I think there's a sense that the market believes neutral is closer to 4, and until recently the Fed thought it was closer to 3. And their guidance was consistent with the belief it was closer to 3. What's sort of crept into the conversation over the last few days, I think, and is consistent with all the Fed speakers we've heard from so far, it's just a bit of nervousness about whether it is closer to 4 or not. And if you're not sure, you go a little bit more slowly and you extend the timeline to get back to whatever neutral might be.
And what we've kind of heard is that evaporation of that confidence almost, because the Powell we heard from when they went from 50, basically talking about the time is now, he felt really confident that we needed to cut fast because neutral was lower, that you need to hurry up and get there or else you'll have some sort of economic damage. If you're not sure where it is, you have to slow down because the risks of overshooting it become all that more acute.
There was this phrase, recalibration. And we thought recalibration was maybe 150 basis points of cutting on autopilot. Turns out maybe recalibration was 75. And we're there already, and it's like, wait and see. We'll continue this conversation through the weekend, into the weekend, and through next week, and into year-end. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Washington Post reporting hedge fund executive Scott Bessent is expected to meet with Donald Trump today. The meeting comes as Trump considers who's going to run the Treasury Department and as transition co-chair Howard Lutnick makes a late play for the role. There is speculation among transition officials that Trump could still pick someone else, such as former White House economist Larry Kudlow or top trade advisor Robert Lighthizer, though Bessent and Lutnick are still viewed as the favorites. Meanwhile, Axios is reporting that Israel destroyed an active top-secret nuclear facility in Iran in its strikes on the country last month. Citing U.S. and Israeli officials, it says the strike significantly damaged Iran's efforts to resume nuclear weapons research. U.S. and Israeli intelligence had detected activity at the facility, including research procedures they say could be used for nuclear weapons. Iran has continued to deny that it's pursuing nuclear weapons. And in sports, the Eagles have extended their division lead after beating the Washington Commanders last night during Thursday Night Football. It was another stellar game from running back Saquon Barkley, who ran for nearly 150 yards and 2 touchdowns. Elsewhere, hockey superstar Connor McDavid became the 4th fastest NHL player in history to reach the 1,000-point milestone. At just 27 years old, McDavid becomes the 99th overall player to reach 1,000 points and the 2nd fastest in franchise history, behind only the legendary Wayne Gretzky. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Thanks for this morning and the whole of this week. That story out of Iran, it's like a scene out of Top Gun Maverick. Going into Iran's secret nuclear facilities, get in, get out, undetected.
Yeah, I mean, it's made for TV out of central casting, if you will.
There's a lot of news going on with Iran as well. Did you see that Elon Musk, according to the New York Times, met with the Iranian ambassador to the United Nations? Now, we've had points in time where Democrats under Trump administration also met with the Iranians, but this might come close to the Logan Act.
Kerry was criticized for doing something very similar. Something very, very similar. Up next on the program, setting you up for the week ahead. That conversation up next, and we'll catch up with Bremo in just a moment. From New York, this is Bloomberg. Stocks are down by 0.6%. The opening bound's about 38 minutes away. You see yields just a bit higher now on the session, following better than expected revisions to retail sales and a headline beat as well. The trading diary for the week ahead looks like this. Later on today, we'll catch up with the Boston Fed President Susan Collins, speaking with Bloomberg's Mike McKee at 10:30 Eastern Time. Tomorrow, President Biden meeting with Chinese President Xi Jinping on the sidelines of the APEC summit in Peru. Tuesday, Walmart and Lowe's report earnings. Wednesday, results from Target, plus the big one, Nvidia. On Thursday, more Fed speak from Goolsbee, plus another round of jobless claims. As we look ahead to that Biden-Xi meeting over the weekend, Lisa joins us now live from APEC. Lisa, walk us through the headlines so far at this get-together and what you're looking for into the weekend.
A lot of the headlines are actually below the radar. A lot of it is this question mark about where the U.S. presence will be here, given the fact that you're not seeing as big a presence from U.S. companies as you have traditionally, and you're seeing a massive presence from China as well as Southeast Asia. But China, yesterday, Xi Jinping rolled in here with quite a procession and flags, really shutting down the whole plaza. A real question here about what the vacuum of power that is being left by a lame duck president who will be meeting with Xi Jinping, what that will be filled by. China right now is being aggressive, trying to fill that gap by investing in places like Peru, like Chile, like Argentina, like Brazil, places with things like lithium, with copper, with other precious metals, with agriculture. Where is the U.S. in this? And what I could feel from a lot of companies here from the United States was, where is the cohesive vision for U.S. companies to invest overseas in some strategically important places?
Trump is certainly the elephant in the room, and he was the elephant in the room of your panel yesterday with Jamie Dimon. What was his message to the president-elect?
Basically, his message was, thank you very much for such kind words, but I haven't had a boss in 25 years, and I'm not about to start having one now. The response that Jamie Dimon was giving was to President-elect Donald Trump's message to him, saying, you know, I respect this guy, but he's not going to be my Treasury Secretary or in my cabinet. Look, this is a lot of noise. There's a bigger takeaway from my discussion with Jamie Dimon. First of all, he doesn't necessarily see inflation coming down nearly as much as markets do, kind of to what you guys have been talking about with respect to retail sales. But on a broader level, he buys into this idea that we're going to see an M&A boom, that we are going to see some more investment from U.S. companies into the United States and elsewhere. But he also raised this point, where is U.S. presence around the world? This, to me, I think, really is the main takeaway.
Lisa, great work, and looking forward to your work over the weekend as well. And looking forward to having you back next week. Bramo there, live from Lima, Peru. A special thanks to Danny Berger, to Anne-Marie, as always, kinder. Coming up on Monday, Steve Major of HSBC, Amanda Lynham of BlackRock, Henrietta Trays of Vader Partners, and the former St. Louis Fed President Jim Bullard. We are back in a Trump news cycle, which means you get no weekend anymore. It just goes on and on and on and on and on. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.